So, good morning, everyone. I'm going to share my screen. We're going to jump right into it, but I do want to make sure before I do, if you are doing this for Manitoba, you're going to have realized from looking at your provincial supplements that we have a large number of provincial forms. So if you don't already have those forms open, make sure you have access today to an MB428, which is where we calculate our Manitoba tax and our Manitoba non-refundable credits, an MB428A, which is where we calculate one specific family credit, and an MB479, which is where we calculate our Manitoba refundable credits. Get those open. We're going to start this morning with our moving expenses and our working from home expenses, and then we're going to be spending a good portion of the second half of class on provincial issues. So the more you have set up and ready to go, the faster you're going to be able to follow along with what we're doing, because it's going to be a fairly brisk class. I'm going to share my screen, make sure that the right thing is showing there. You should all see my rules of engagement slide. I'm going to go back one and say welcome to part 5, welcome to chapter 5 today. As always, the more class discussion we get going, the more useful it is for me. I can tell when you have questions and what I need to clarify. And also I get to know you a little bit, you get to know each other. We're going to start with two fairly detailed but not overly difficult deductions. Yes, they're both deductions. So we're going to do moving expenses first. Some of moving expenses you have already learned because you learned about establishing residency. So determining when someone has established residency is important when we do moving expenses. I'm going to be testing your knowledge on that from chapter 1. And we're going to talk about working at home COVID expenses. So that's something that's very specific just to the last few years, and we'll talk about that in more detail. We're going to talk about calculating tax. That, again, is going to be review. We've already looked at that in the first few chapters, so we're going to go quickly through that. I'm going to talk about two specific types of non-refundable credits that show up towards the end of the tax calculation. We're going to do political contributions and labor-sponsored funds. And then we're going to spend pretty much the rest of the class on provincial because, again, Manitoba has a lot compared to some of the other provinces. We are going to be busy today. And then we're doing refund and balance owing. And after today, you will be calculating complete tax returns for the entire course. So the rest of the course, every tax return you do, you're going to start at the first page and you're going to get all the way to the last page. And you will have a refund or balance owing from this point on. Okay, I'm going to go through these very quickly. So we're going to make sure that you know when you can claim moving expenses. We're going to know how to calculate political contributions. We're going to talk about LSVCCs. That's something that not every province does. And federally, they don't have those anymore, but in Manitoba, we do. So we will talk about that briefly. And then we're going to talk about calculating tax and taking the tax credits off. So non-refundable tax credits bring tax down to 0. And then we're going to talk about the provincial forms 428 and 479. And of course, in Manitoba, we have one extra, the 428A. And we're going to get to the end of the return. Okay, let's jump in right away with moving expenses, okay? When you're dealing with moving expenses, you have to understand that lots of people move. People move all the time. Not everybody who moves gets to claim moving expenses. So moving expenses are not there just because you moved. They're there if you moved and you meet certain tests. The tests you have to meet are on this slide, but I'm going to add one more to it for you. Before you even get to the first question of did you move far enough, you do need to ask, did you move? And that seems like a very easy question, but everything in tax is a little more detailed. So moving means changing your residency, your tax residency. You don't necessarily have to move between two provinces, so you might have your tax residency in one location in Manitoba and then establish residential ties in a different location in Manitoba. But you do have to change your residential ties in order to move. So can anyone remind me from Chapter 1, what is the first question we have to ask when we determine where somebody's residential ties are? What is the number one question we ask? And if you don't remember, go back to illustration 1-1 in Chapter 1. Thank you, Brittany. It's where you live. It's your dwelling. Where is your home? So in order to move, you have to change your dwelling from one place to a different place. That's going to be important to remember because it seems easy. Most of the time when you move, you leave one place that you live in and you go to a different place. But of course, we've already discussed situations where you might have two dwellings, or you might have no dwellings because you might move to a place where you have not established residential ties. You might move from your home into student housing, in which case you have not actually established a dwelling. So that is a question I want you to remember before you even think about moving expenses. Find out if your client actually moved, and I'm going to test you on that later with some examples. Okay, once you've established a move has happened, then we can talk about, does that move qualify for a moving expenses deduction? So the first rule is you have to have moved at least 40 kilometers closer, and I'm going to say today for a work location. It's closer to either a work location or a school location, but I haven't taught you about students yet, and students have some special rules when it comes to income and other things. So when we get to students, we're going to revisit how moving expenses work for students. For today, we're going to focus on the idea of moving closer for work. Okay? Generally speaking, though, the purpose of the move has to be to move for a new job or for school. And again, we're going to talk about school later, so for today, you have to move for a new job. If you move just because you want to be closer to the job you already have, you do not qualify for moving expenses. It has to be to start a different work, a new job, a new business. Okay? And then finally, the expenses that you claim can't be more than the income that you earn in the new location. Now, that being said, moving expenses are nice because you can carry them forward to the next year if you didn't use them. So we're going to talk about that as well. But what you put on the return in the year, you cannot have a loss from moving. So you can only deduct up to the amount of income you've earned at the new job. Now, Helene asks a really good question. What if it's a new position? It does get complicated if it's a new position in the same company. The CRA actually has gone to court over this. Of course they have. The court cases that we see are suggesting that as long as it is fundamentally a different job that you're doing in the new location, it counts as a new job even if it's for the same employer. So definitely if you are working in one position and then your job duties substantially change, that will be considered a new job even if it's with the same employer. It even gets fussier if you are moving and you have the exact same job, but you're doing it in a different place. So there are people who will be hired, let's say, at a law firm, and they're hired to work at a law firm in, I'm going to say, maybe they're working in a law firm in a rural area in Ontario, and then they're working in the same position, in the same level of lawyer, and then they get moved to a Toronto office. Well, I would say that doing your job as a lawyer in a small rural town in Ontario is fundamentally a different job than doing it in downtown Toronto. And so the court has agreed if what you are doing, even if you have the same title and same salary and the same employer, is fundamentally different because of a move, that will count as a new job. And Brittany asks, who dreams they have a chance of taking the CRA to court? You'd be surprised, a lot of people actually do take the CRA to court. It's a pain to do. It takes a very long time. And if it's a really, really messy thing, it can also take years because once you go to court, you go to federal court, you win, you don't win, there's usually an appeal. If it's really messy, you go to the appeals court. If it's still messy, you end up at the Supreme Court, and there are tax cases that have ended up at the Supreme Court, and you're probably looking at 12 to 15 years before everything gets sorted out. So it can be difficult and expensive, but it is also how we determine how to interpret the rules, because the rules seem very easy. It's just new job, but the definition of a new job can be different. And you're going to find in moving expenses that I can't give you an easy answer every time. So sometimes we run into these gray areas where it is a little fuzzy, and you have to make a judgment call to say, do I think this is going to fall within the rules, or do I think it's not going to fall within the rules? And I can't always give you a yes or no answer. I can give you a what I would do answer, and what I would do might turn out to be different from what the CRA would do, and that is also how people end up in court. All right, but we're going to talk about that. So always ask, first of all, did they move? Second of all, if they moved, did they have a new job? And are they moving because they want to be close to that new job? How much closer do they have to be? 40 kilometers. Okay. There is no fixed time limit, except there is a time limit. So it's not a fixed time limit, but it must be reasonable. So is it reasonable to get a new job and then not move closer for 5 years and then move closer? Will that count as moving for the new job? That's going to be hard to argue, to say I had to wait 5 years before I could move. If you can come up with a reason for it, it might work. On the other hand, there might be reasons why you can't move right away. So imagine you're in a place like Brandon and you get work in Winnipeg. What are some of the reasons why? Let's say you get the job, it's now, I'm going to say February. You have to start working in Winnipeg, but you can't move, or you and your family can't move just yet, and you're going to be commuting for a while. What are some of the reasons people might do that? Kids is the big one. Kids are in school. Maybe you can't sell your house. Thank you, Leon. Great. If your house is delayed, you can't sell it. You can't afford to buy a new one until you sell your old one. There are reasons why you might not drop everything and run and move right away. And that's reasonable. Brittany, it's too cold to move. Yeah, that would be one. We live in Winnipeg. I think you could convince a CRA court if you had to. If you went to federal court and say, there was no way I was packing up my whole house in February and in the middle of the prairies. I waited till it was spring. The longer the distance between the move and the new job, the more difficult it's going to be to get the CRA to agree. So you have to be able to prove a reason for a delay if there's a delay. Those of you who's read the book, I'm going to ask another question. Do you have to get the job first, or can you move and then get a job? You can move, good. You can move first in the hope of getting a new job, and then you get a new job. And will that be reasonable if there's a delay? Yes. But again, how long a delay? So for example, I'm sure you've all seen the opportunity, especially for young people. You finish school, you decide to travel the world for 9, 10 months, a year, then you find a place, you settle in it, and you get a job there. Is that delay going to be reasonable? In that case, are they going to say that you moved for work, or are they going to say that you traveled a whole bunch and you had a nice little vacation and you enjoyed yourself thoroughly, and then eventually you decided to find a job? In that case, it would be harder to argue that you moved for work. So this is why I said it gets a little fuzzy. The longer the distance of time limit, the more you have to be confident that you can justify that the move was for work purposes and not otherwise. So did they move? Find out if they moved. If they did they have a new job? If they didn't have a new job, they don't get to claim moving expenses. Again, except for students. We'll talk about students in the student chapter. Can anyone name some of the people who might move who aren't going to get moving expenses? I'm thinking particularly maybe some of our older clients will definitely have reasons why they move homes. Yep, you might be moving closer to family. You might be a senior and decide you want to be closer to your young family. You might be moving into assisted living facilities, things like that. All of the people who move in the country but don't move for work have the same costs, but they don't get to claim them on their moving expenses. So this is probably one of the hardest things we have to explain to clients is people who have moved and then they have all their receipts and they bring them in and they know that you can claim moving expenses on a tax return, and we have to explain not everyone can claim moving expenses on a tax return. And then lastly, you have to actually have expenses to claim. So you're going to see this a lot in Manitoba. We have a lot of military families. What does the military do when they make people move? Very often, what is one thing they do? Because if you're in the military, you're probably going to be moving all over the country for your life. They pay. So if your employer is paying for your move, then you don't have any out-of-pocket expenses. If you are reimbursed for all of your moving costs, even if you have receipts, you don't get to claim those on your return because you did not pay for them. Your employer paid for them. You can only claim what you paid for out of your own pocket up to the amount of income you earned at the new location. Okay, let's dig into some of this a little bit. I'm going to show you a T1M. Now, I find this particular one a little bit difficult to read. So I'm going to go through the next 3 slides, and then what I'm actually going to do is I'm going to pull the form up on my computer. Okay, how do we find a T1M form? Where will we go to get a T1M form? CRA website. If it's in your fillable forms, it should be in your fillable forms. I don't actually know because I haven't looked at them. But anytime you want to find a form, oh, it is great, wonderful. So if it's there, you can use it from there. Anytime you want to find a form, if you know the name of the form, go ahead and type the name of the form, T1M. If you don't, you can say moving expenses and see what they come up with, and they will say T1M right at the top. Okay. Every move that you qualify for, you can fill out a T1M. You have to fill out the T1M in the year of the move. So if you moved on December 31st of 2021, you have to put your T1M on 2021. If you moved on January 5th of 2021, you have to do it at the time you moved. That's normally easy, except remember that moving expenses are generally done by family. And 2021, can you still carry it forward? Yes, we're going to talk about carry forwards. Okay, so if you have no employment income in 2021, then you can carry it forward. We're going to talk about the complicated situation where you move first and then you find a job after, and that happens between years, because that does happen, and there's a way to deal with it, and I'll tell you what that is. But let's start with the easy one, which is 2021. If you move in 2021, you fill out the form in 2021. But generally, we move and we claim moving expenses as a family. The family unit would be all of the people moving together. So if you have 2 adults who are married or common law and they have young children, you will calculate the expenses for the family, and then you can split between parents if you want to, between taxpayers, or you can claim them all on one, but you can't claim more than the maximum, more than the actual expenses you incurred. Okay. So the complication is picking the date, because sometimes if you are moving as a family, you don't all move on the same day. Sometimes your move takes a couple of trips and happens over the course of a month. You're going to have to come up with a date that is the most reasonable for essentially when did the move happen. So you might have a circumstance where you have 2 parents with a young child. Both of them are moving for a new job in a different city. One parent stays behind with the younger children. The first one flies out to the new location. They stay in temporary housing for a while, or they rent, or they move into their new place. There's lots of things that could happen. And then like 6-7 months later, the rest of the family comes with them. You're going to need a date, and it could be when the first person moves, and it could be when the rest of the family moves. It just has to make sense. Okay, but you're going to have to put a date on there, and it has to be in the tax year, and that's the important thing. What I like about this form is what I'm showing you now, which is the first 3 pages. There are a lot of instructions on the actual form. If you have a question for what counts or what the definition is, or is something included or not included, go to the form first, because the answer is probably in there. So are you employed or self-employed? This is what you need. What are the rules? It's 40 kilometers. How do you calculate it? It can be detailed or simplified. All the things I'm about to teach you are already on the form for you to find. Okay? The first 3 pages are just information. Then we get here to the most important page of the form. This is the page that says, can you claim expenses at all? So if you cannot complete the first page, then you can't claim moving expenses for that client. Okay? Top corner, you need a tax year because you can have multiple moves in 1 year, or you can move any year you want. So make sure you identify for the CRA which year the move happened in, and then who is the taxpayer who you want to claim moving expenses for. Then you have to have the distance between your old home and your new place of work in kilometers. How do we get that? So the nice thing is, this is a lot easier to do now than it would have been about 20 years ago. Google Maps is wonderful. So the CRA will accept a Google Map solution for calculating kilometers. We don't have to pull out a map and a ruler and calculate it ourselves. I get this all the time. You're going to get the main address of the employer or the location where the person is working from. So where do they go to work every day if it's one location? You're going to put that address in. You're going to put the address of their old home in, and you're going to ask Google, how far is that? And you're going to take a reasonably direct route, and that will be acceptable to the CRA for the distance. Okay? Then we do distance in kilometers between the new home and the new workplace. And as long as that number is 40 or more, so 40 kilometers or more, we can do moving expenses. If it's less, then you're not going to do the rest of the form. You're going to stop. Okay? Then we need the details of the move. We need the date of the move. You have to decide what that is. So again, if it took them 3 weeks to actually get their stuff out, the move can be the date that they started leaving. The move can be the date they finished leaving. It's going to be what's reasonable for the circumstances you have in front of you. And then the date that you started working or running a business or studying full-time in a new location. So the day you started the new job is going to be there. And again, if those 2 dates are very close together, it's probably going to be reasonable. The further apart those dates are, the more you have to be prepared to have proof. So let's say the reason that it was delayed was because you had to sell your old home and it really wasn't selling. What kind of proof could you give the CRA that that was the reason that delayed your move for your new job? That the move is for your new job, it just took you a long time. So the day of the sale on the old home, yes, but that's not going to be enough. We're going to look for why did it take so long. You can show evidence. Maybe you had to list it multiple times. Maybe you can show, what was the work you did to prove that you really did try to sell your house and it didn't sell. If you didn't try to sell your old home, then they're not going to accept that as a reasonable excuse for a long move. If you can show that you were actively attempting to sell it and the market was just not good, then it will be fine. So again, the more evidence you have, the longer the delay, the more you're going to have to prove that it was a reasonable delay. Because it's not okay to say, oh, gee, I think I can commute, it'll be fine. And you do that for 10 months, and then you're like, actually, I don't like this. And then you change your mind and decide to do something about it. That's not going to be moving for a new job. That's going to be moving for a job you already have. And yes, letter from a kid's school. School reasons is a little bit easier. You can say, look, my kid was in there going into their last year of high school. We were, 3 months away from the end of it. We just wanted to let them finish. That's always going to be accepted. On the other hand, if your kid is in grade 2 and you want them to get to the end of high school before you move for your new job, probably not reasonable. So it's always a range. It's always a little bit fuzzy, but what is a valid reason? Okay. And then you have to pick, is it to work or run a business or to study full-time? For this portion of the course, because I haven't taught you about students, make sure you can answer that it is to work or run a business. When we get to students, we're going to come back and talk about the other option. Okay, now you need some details, the address of your old home, the address of your new home, and information about your employer. When you move, you are claiming moving expenses for one new job, okay? Or if you and your spouse both move, you can each claim by splitting your family move between two employers, but one job each. So you don't get to move, get a job, and then get another job, and then claim it against all of that. There is only room for one employer on this form, so you have to pick which employer you're going to claim expenses against. Why might that be relevant? Let's say I move and I get one part-time job and one full-time job. If I put the part-time job down as my employer, what am I limiting? Could I have that job for 3 months and then I'm never going to do it again? I'm limiting how much I can claim, because the maximum I can claim is the new employment I got from that job. So if I only get a little bit of employment from that job, and that's the job that I put on here, then that's all I'm going to be able to claim. So if you have someone who moves and they want to claim moving expenses, before you even start filling out the form, make sure that the job you're putting down here is going to have enough income to be able to absorb the moving costs, or a reasonable amount of the moving costs, so that it's worth doing the form. You'll find very quickly these are forms we want to do, absolutely give our clients tax credits. They are a lot of work. So if the benefit of all of that is going to be about $12, then that's probably not something we're going to spend a lot of time doing. And Helene, you can carry the credit forward. So if you don't use up all the expenses against the income this year, you can claim it against more income from the same employer in the future until the expenses get used up, but from the same employer. So that's important. So you remember I said you might move on, let's say, December 29th. And if you move on December 29th for a job that starts on January 2nd, you will have zero income from that job. You have to claim the move in the year you move, so you have to do the form for December 29, 2021, and your income will be zero. But next year, your income will be higher. So you're going to carry those forward, and then you're going to claim the income from next year from the same employer. And Leon, are there rules regarding unreasonable expenses? Yes, we're going to get into the expenses in great detail. Okay, so yes and no, but yes. So if you can fill that out, if you have a new job and it's 40 kilometers away and you actually moved, and we have picked the employer we're claiming the expenses against, and we've decided everything's reasonable, the first page is done, then we can get to what are we allowed to claim. So you're going to put storage and transportation costs. We're going to talk about that. We're going to put travel expenses. We're going to talk about that. Cost of canceling the lease for your old home, cost to maintain your old home, cost of selling your old home, cost of buying your new home has a special rule. We're going to talk about that. Everything you can put will fit on one of these lines. If it doesn't fit into one of these lines, then you can't claim it. So you're not going to claim every cost your client can think of related to the move, but if it fits within the rules of what you can claim, then yes. Okay? And then at the end of it, you're going to come up with all your moving expenses, and then you have to subtract any reimbursement you got from your employer that you received for your moving expenses, as long as that wasn't included in income. So if they give you, let's say, a signing bonus that is taxable, that's not a reimbursement or an allowance. But if they say we will cover up to $5,000 of your moving expenses, if they give that to you tax-free, you have to put that $5,000 here. And the only bit you can claim is the money you paid on top of that, because the first $5,000 of your move you didn't actually pay for. So you're going to total your moving expenses, subtract your reimbursements, gives you your net, and then we have to decide how much income are you going to deduct. We'll talk about that too, because it gets a bit difficult to calculate, but it does give you all the details for how to do it on this page. I come back to this page every time I have to do moving expenses, because I have not memorized all the line numbers. I look them up. And Helene, so if the reimbursement is not taxable, usually it isn't taxable. Usually it's just something they'll cover your costs for you, and they won't include it in income. So especially, again, if we're dealing with Department of National Defense people, They cover everything. It's not taxable. And we look at them and go, moving expenses, great. How much did you pay? And they go, I didn't pay for anything. And I go, all right, then we're not putting moving expenses on your tax return. And that's the end of that conversation. And off we go to the next one. All right, at the end of the day, you're going to find out what income you have minus the expenses you have. If there's anything left over, you can carry it forward to a future year. And the way that you do that is next year you will have another moving expenses claim. So that if you do have that thing where maybe you moved and you had a very expensive move, you moved all the way across the country with 6 people, and you just don't have the income to cover it all now. As long as you're still with the same employer and you're still earning income from that employer, you can claim the rest of your costs in the next year. Okay, so I love this moving expenses form. It has everything I need on it. If I ever need to look anything up on moving expenses, I come straight back to the form. Normally I tell you come back to the book because the book is wonderful. I do think the book is wonderful. I just find looking it up in the form even faster for me. All right, let's talk about the beginning of it. Who can claim moving expenses and who can't? So we're going to use our participants window here, and I'm going to ask you to give me a green check mark if you think Carla can claim moving expenses and a red X if you think Carla can't. Carla has lived outside the city 60 kilometers from the employer that she's worked for since 2011. In 2021, she moved to a place much closer, 3 kilometers away, from the same employer. There was no change in employment position or location. Would that count as a move for the purpose of moving expenses? Green check mark if yes, red X if no. Okay, we've got mostly no's. I agree with you. What kinds of places would she live in where it would be reasonable to be 60 kilometers away from work and commute? What are the places in Canada where that would be a thing that happens all the time? Because I will tell you that is not common here. So Manitoba, unless you're right on the outskirts somewhere and you're kind of getting into Winnipeg, maybe. But most people who are living 60 kilometers away. So Steinbach to Winnipeg, yes, that is a place where it happens all the time. Toronto, let me tell you, if you want to work in Toronto, you're not living 60 kilometers away from your work. You're way further away than that. Vancouver, larger cities. So big cities, this is a normal thing. On the other hand, if you're working in Brandon, probably not living 60 kilometers away and then deciding to move into Brandon afterwards. So smaller areas, this will be less common. If you're living in a city outside, let's say you're living in Morris, let's say you're living in Portage-la Prairie, if you're moving from one town to a different town, that might be enough if the job is moving with you to be considered a move for a new job, if the job is moving as well. If the job isn't moving and you're just commuting, then no, it's easy. But if you were working in Morris and then your employer said, actually, we want you in the Winnipeg location, same job, but starting from a new place, that might do it. Whereas in Toronto, if you're working at one office on one side of Toronto and they move you to an office on the other side of Toronto, that's going to be considered the same job, even if it's a huge addition to your commute. So again, look for reasonableness, but in this case, I think we all agree, no. All right, let's do another one. Bob lived 90 kilometers from the nearest city, got a job in the city in December of 2020. Bob commuted daily until he was able to sell his house in March of 2021, and then he moved to a new house 15 kilometers away from his job. Did he move? If he moved, can he claim moving expenses? Is it for a new job? Okay, if you think he can move, claim moving expenses, give me a green check mark. If you think he can't, give me a red X. Okay, I'm seeing some check marks. Excellent. Good. What year will he file his T1M for? 2021. Because when did he move? He moved in 2021. Excellent. I'm going to look at that 2021 form. I'm going to go back to my moving expenses form here, and I'm going to ask you, what month is he going to put for the date of the move? His date of the move has to match the tax year, March of 2021. What is he going to put for the date he started to work or run a business or study full-time? December 2020. And that's fine because 4 months to sell a house sounds reasonable to me. That delay is an explainable delay. So the date of move year has to match the form T1M year. Those have to match. And then the second date might be in a different year. The distance is going to be the question of how reasonable it is. Excellent. Good. Going to make it a little bit harder. So we're going to do some annotation on this one, because I like to take things from real world experience, because you get through this and you're like, oh yes, this is very easy. And then you sit down in an office and you go, I have this client. What do I do with this? So Dennis Sigalot is 20 years old and he lives in Moose Jaw, Saskatchewan. Frustrated by the lack of employment opportunities, on May 20th, 2021, he decides to move to Toronto to look for work. He finds a job on June 3rd, but quits after only 2 weeks of employment. He has a T4 with $350 in box 14. He continues to look for work, and he finally finds a better job on August 9th, 2021. His second employer issues a T4 showing $14,800 in box 14. So, can he claim moving expenses? Let's do yes or no for that first. Give me a green check mark if you think he can claim moving expenses. He moved without having a job, and then he found 2 different jobs. So we've got a bunch of check marks going yes, I agree he can move. Excellent, we're all on the same page. So even though he didn't have a job before he moved, he can still claim because he moved in order to get work. Now, what is he going to put on line 22 as net eligible income? Now assume that we're going to take the CPP off. So I'm going to take the deductions off, but what is the income that he's going to base it on? So I think mostly everyone is agreeing, and this is probably the best result I've seen in a long time since I've taught this, so that's good. It means I'm explaining things clearly. $14,800. Yes. Why is it that number? Why did we pick the second job and not the first job? It's a higher net income, so he can claim it. And Brittany, yes, there's no way if he moved from Saskatchewan to Toronto, his expenses will be more than $350, even if we only do just the bare minimum of travel. So we're going to pick the job that he can actually claim more expenses from. When we do that, we have to ask, though, is the new job going to be reasonable to be considered connected to the move? So if he moved in May and he got a job in August, is that a reasonable time to be looking for a job? I would say yes. On the other hand, if that distance was much longer, maybe he quit the first job and then he kind of traveled around and did some things, and then, a year later, he settled down and found a job. Probably not. So you still have to look at the move you're doing and going, if I put this on a form, am I going to be able to explain it? In this case, I would say yes. Good. Why can't we do both? Why can't I add them together and claim all of it? There's only one employer on the form, so we have to deduct it against one job. Really good. Very good. If you get this case, you understand real world scenarios for how to do the form. So everything comes down to, what am I putting on the form? If it doesn't fit in the form, you have a tax theory problem, not a form problem. Okay. Excellent. I'm going to do one more. And I'm going to give you a hint on this one. Okay. And this one we're going to do a poll for. So as you read it, I just realized I have not loaded my polls, so I'm going to do that right now. Give me a moment to get that set up. Knew there was something I forgot to do today. Okay, so we have Robert. Robert is a teacher who lives with his wife and 2 children in Winnipeg in a house that he owns jointly with his wife. In September of 2021, he accepts a new job as a teacher in a school district in the Northwest Territories. He rents a house through the school board and drives up with his personal possessions in his truck in August. He plans to visit with his family 1 weekend per month and on school holidays. So I'm going to be asking you 2 questions in the poll. I'm going to ask you if he can claim moving expenses, and I'm going to ask you what his province of residence is for 2021. So what province is he resident in on December 31st of 2021 for the tax purposes, okay? So you're going to answer both of those questions, and I'm going to give you a hint. Consider illustration 1-1 in your text before you answer this. So if you hang on a second, I'm going to give you a multiple choice poll, and let's see what our options are. So he can claim moving expenses. His province of residence is Northwest Territories. He can claim moving expenses. His province of residence is Manitoba. He cannot claim moving expenses. His province of residence is Manitoba. Or he cannot claim moving expenses. His province of residence is the Northwest Territories. What do you think? And again, obviously names and everything have been changed, but we're working off of real world scenarios here. So these are things that happen. And I love this one because I get a real mix of answers. See how we do. Okay, really, really good interaction on that poll. Lots of people giving it a try. I know this one is difficult. This is more difficult than you're going to get for anything we're going to mark you on in this course. But again, if I give you a complicated question and you can figure out why it works, then you really start to understand how the rules get applied. So let's share our results. Okay. So we've got a mix. We've got a few people who say he can claim it and he's in Northwest Territories. A few people say he can claim it, he's in Manitoba. Some people saying he can't claim it, he's in Manitoba. Okay. Question we have to ask first is, did he move? So when we talk about if he moved, where is his dwelling? Well, his dwelling is both in Winnipeg and in the Northwest Territories. So we can't answer where his residency is based on that. We have to go to step 2. Step 2 is, where is his wife and kids? And the answer for that is Manitoba. So where is his province of residence? He's physically in the Northwest Territories. He has a job in the Northwest Territories. He has a place to live in the Northwest Territories. But what's more important is, where are his residential ties? And his residential ties are in Manitoba. So if you said province of residence is Manitoba, you are correct. Now, if his province of residence was Manitoba and his house is in Manitoba, did he move for tax purposes? No. He physically drove a bunch of his stuff to a new address in Northwest Territories, but he did not move. If he did not move, can he claim moving expenses? Unfortunately, no. So what happened in this case was there was a client who brought in moving expenses for a different tax preparer in a different organization than ours. And that person put moving expenses to the Northwest Territories on his return. And, well, it wasn't Manitoba, it was a client in a different province originally, but he moved up north to teach. They did the move, and then the CRA audited him, and the CRA said no. And he came to H&R Block and said, explain this to me, because I got this nice big refund, because he had very expensive move. He had a lot of stuff, and it was a long distance. And so we got a really nice deduction that they took away. And we looked at it and we said, unfortunately, the CRA is correct. It should never have been claimed in the first place. And the CRA did not allow it, and they would not have allowed it because he never actually changed it. And Helene asked a very good question. Aren't moving expenses always audited? Basically, yes. Moving expenses is a place where a lot of people don't keep records and don't keep receipts and claim things they shouldn't claim. And so the CRA is very happy to look into a lot of moving expenses. If you claim moving expenses, you can expect not necessarily to get an audit. It won't be a full investigator coming to your house to talk to you kind of thing, but you'll get a request for info. The request for info says, oh, you're going to claim all of this stuff. I would like receipts. I would like to see your more details. What proof do you have? And if you don't prove it, then they take the credit away. I've done quite a few, again, where we are correcting things that other people have done. So I had one client where she moved, what order was it from? She moved from Victoria, BC to Halifax, drove across the country. That's a lot of moving expenses. And then the year later moved from Halifax back to Victoria, BC. And had an accountant do her first move, and the accountant did not calculate things correctly or have the right information on the moving expenses. It was audited. It was all taken away. And then they went to me and said, can you fix this? And we had to completely redo it. We were able to get her moving expenses because she had moved, but we got different moving expenses than the one the accountant had put on because we had to make sure we had documentation to back it up. And then when we gave them the documentation and we did the adjustment, she was able to get almost everything back. So, and Leon says, can't he claim from the previous accountant? You can try. You know, sometimes with accountants, especially if they're independent, they are hard to find or they don't have any money. You can try going to court for it if you can prove they were negligent, but they may have just, you know, done a bad job. So you can try. More importantly, generally, I would say is fix it if you can fix it, and do it right when you do it. That's the other one. All right, so that is understanding that a move has happened and that we are going to do a T1M. If you've got that, you're ready to go. Always think about it first before you start the form. I have seen this especially with new associates who come into an office. They get really excited. They've got to move. They're halfway through getting receipts from their client and doing stuff, and then they get stuck on something. They come and call me over, and I sit down with the client, and I realize they didn't actually move, or they didn't move far enough, or they didn't move for a new job. And now you've just spent a couple of hours and sent your client to go get receipts, and then I'm going to tell them we're not using them. So spend your time on the first page first. If you can finish the first page, then go ahead and do all of the details, because it takes time. Moving expenses are a lot of work to fill in. So put the work in after you finish theory, which is, did they move? Can we claim the moving expenses? All right, let's keep going. What can you claim? So remember, some expenses can occur the year after the move. So you can have expenses now and more expenses later. This happens again, especially when you get to the end of December and you have part move here, part move there. So you can fill in more expenses. You can add more expenses to the move. Usually we try to do one T1M when we have everything together. So this isn't a huge issue, but it can happen. For example, you might move first, claim your moving expenses, and then if you've sold your old home and bought your new home, that might not happen for another year because the market might not be good, in which case you can do an adjustment to claim the rest of the expenses. Okay. You can claim multiple moves in a year if you have multiple moves that qualify. So I had a client. This is the nice thing about me working for a long time before I teach this course. I can almost always say I had a client that did something. I had a client who at the beginning of the year moved with her husband and her new baby from Ontario to Halifax, got a new job. Husband got a new job, but her job was more income than his, so we claimed the move on hers. And then the relationship broke down. So the stress of the new job and the new baby and being away from home, they basically got into a really not good situation. And 4 months after she'd moved there, she moved back to Ontario without him, and they separated. And so she was now in Ontario with her child, and she started a different job than the first one had been. And we were able to claim, in that case, moving expenses against the first move to Halifax for her, with her expenses and the family and all of that, and then a second form for the same year for her and her child moving back to Ontario against the new employer. So 2 different moves in the same year. Of course, we warned her, you're probably going to get a request for info, but we had all of the documentation we needed, and we could show that she really did intend to move. It wasn't a temporary visit to Halifax, picking up a little bit of work. They had sold their house, like everything had happened. So her intention was to move and to stay. The fact that it didn't work out doesn't mean she can't claim the credit coming back. The more moves you claim in 1 year, the more you're going to have to justify it to the CRA. But if they are legitimate, then they are legitimate. And this situation, certainly was something that happens in real life. Couples can split moving expenses, but you can't claim more than you paid out of pocket between the 2 of you. So if you're going to do that, you're filling out 2 T1Ms, and you're going to limit the expenses. And you can decide how you want to split the expenses. You can put 50-50, or like anything else, you can split it any way you want. So if one person had a little bit of income and you want to get theirs down to 0, you can claim just that and then the rest on the other. But they both have to have moved for work. So this only works if they each have a new job. So in order to split moving expenses, they both have to have a new job connected to the same move. Okay? And the rule that a lot of people don't know, you only get moving expenses if you move from one place in Canada to a different place in Canada. There are a few exceptions to this which are outside of the scope of this course. So it is possible in some very limited circumstances to claim moves outside Canada for what we call deemed residence, but that's going to be far beyond anything we do. We do get a lot of clients who will be Canadian citizens who lived in Canada, went and lived in a different country for a number of years, and then came back to Canada, and they would very much like to claim the cost of their flights and shipping all of their furniture across, from the United Kingdom to Canada, or from wherever it is in the States up to here. They would like to claim their moving expenses, and they cannot. It is explicitly not allowed, and it is actually written on the form on the first couple pages. Moves have to be from a place in Canada to another place in Canada. Okay. Any questions about these rules? Okay, we're going to keep going. What can you deduct? Well, anything related to the transportation and storage, reasonable storage of your stuff. Reasonable storage, again, if you just decided to leave things in a locker for 5 years and now you want to get them back, probably not going to count. On the other hand, my husband and I had a situation where we moved for 1 year for a new job for him. We left some of our stuff in different places along the route, and some of that storage was reasonable because we couldn't take it all the way with us, and we ended up having to store it temporarily before we could get it to where we were going to be. So again, fuzzy gray area. Generally speaking, though, a lot of people do have a storage cost mid-move. So transportation and storage costs, generally we're talking about what's happening during the process of moving. So, for example, you might have a moving company move your things, and they're going to hold on to it for 2 weeks while you're getting your new home set up, and then it gets moved into your house. That's the kind of cost we're talking about. And Brittany, so as I say, as a taxpayer and see and think this is unreasonable, they wanted to put on a return anyway. If it's definitely not going to be allowed, I would be uncomfortable putting it on the return. But there are things that I can't say definitely wouldn't be allowed. In that case, what I would do is say, all right, I will put this on for you because you want me to, but you have to understand that if it's disallowed, that you're going to have to pay that back. And I would expect that to be the case. And sometimes it is a gray area, and then put a note in your file that says, we had this conversation. I told you I don't think this is going to fly. You wanted to put it in anyway. I did, but I told you not to do it. It's their tax return. It's not fraud, as long as they're not trying to put something on there that's completely wrong. If it's just in that gray area and you think it's not going to work, have that conversation with your client. and let them know what the risks are and if they want to go ahead with that risk. And it is reasonable, like I say, it can't be tax evasion, then if it's in that gray area, they can put it in. I wouldn't put it on anyway all the time. So there are people who are saying, well, I don't think I'm going to get it, but I'm going to see what the government does. That's a bad plan. That's a bad plan for you. It's a bad plan for your client, because paying things back from the CRA, two things happen if they have to pay them back. The first thing is usually it's a couple of years before they have to pay it back, so now they're paying it back with interest, which is a lot worse than just not getting the money in the first place. And the second thing is if you get caught on an audit 1 year, the government is very happy to be like, oh, we audited you and we got money back from you. Let's see what you put on your last 3 tax returns. And all of a sudden you're getting more and more and more letters and you're having to prove more and more things. So you want to do an accurate return to the best of your knowledge and ability. And most clients are reasonable. If you explain, look, this is why the CRA is not going to be okay with this, they go, oh, okay, well, I don't like it, but I understand. Most clients want to do the right thing. There we go. And there have been ones that I put on and I said, look, I think it's reasonable. I hope it's reasonable. I'm going to put it in. And if the CRA comes back and says they disagree, I'm going to write a letter back to the CRA and say why I think it's reasonable. And sometimes that works. So yeah, gray areas are the fun parts of tax returns. The part where you really have to think about it and go, but think about it from the perspective of the CRA, not from the perspective of what I want in my pocket as a client. Think, if I was the CRA, would I accept this? And I think that's a way to make sure that you're making your returns audit proof as much as possible. All right, so transportation and storage costs, things that people don't think about in transportation and storage costs. The easy ones, movers. If you're paying movers, yes. If you're paying movers who are storing things, yes. Also, U-Haul rentals. Also, bubble wrap, boxes, packing tape. Anything you have receipts for that is related to the cost of moving your stuff. So transportation and storage is for stuff, not for people. And then the next section of the tax return is travel expenses. So now we're going to talk about what's happening while you are physically moving people. So travel expenses is going to be, it might be public transit, it might be buses or train tickets or airplane tickets. It might be airplane tickets plus a little bit of baggage fees. Now, baggage fees, if they're really high because you're shipping stuff, that's going to go in transportation and storage costs. If it's, I brought 4 suitcases and I paid for an oversized bag, I would include that in my travel expenses with my flight. That's probably fine because it's going to be acceptable either way. We're going to talk about simplified and detailed travel in a bit. You can also claim travel for the road. So if it takes you 4 days, you're going to be eating some meals. If you have to stay in hotels, everything that happens while you are getting from place 1 and landing in place 2 falls within travel. And we did have the question, what's reasonable, what's not reasonable? Is the CRA going to accept that you had to stay in the most expensive hotel every single night along the route? I mean, you can try. It would be hard to suggest that that was a part of your move and not a thing you did for fun. So one thing that happens with moves, and I've done this a lot because I've moved a lot, sometimes when you're moving, half of your move becomes a road trip or a vacation where you're like, oh, this is really nice, but also we're going to stay in one city for 4 days and visit friends and maybe do it up in a nice hotel. I don't know that I could justify those expenses as being related to the move. That's vacation time. But it doesn't have to be the cheapest motel along the route. You are allowed to be comfortable while you are moving. And so, you know, we're going to go back to, is this cost related to the move? If it's related to the move, go ahead and put it on. Do you have to camp while you're moving to keep costs down for expenses? No. That would be not only crazy, but my husband would never do it. He's not a camper. So reasonable to a perspective. If it's over the top, they're going to start asking, is this actually connected to the move? Same thing for meals. Do you have to eat at, McDonald's and, the cheapest food you can find? No. Can you have a nice dinner while you're in the middle of a move? Yes. If every single meal you eat while you are moving is a $600 meal, I think the CRA is going to ask whether or not you were actually eating those meals because you're traveling or eating those meals because you decided to have a food tour, vacation, fun event. So everything comes down to the reasonable test. Okay. Now we have additional expenses because, yeah, we'll talk about the number per day in a minute. So we'll get back to that. Simplified versus detailed, we're going to go into more explanation. Okay, so we have the travel itself. We also have temporary living expenses. So sometimes what happens when you move is you actually physically have to do the move at a certain time, either because you have to get there for work by a certain date, or you have to get out of your old house by a certain date, but your new house isn't ready, all of those things. You may have some temporary costs either right before you leave, you might have some temporary expenses, or right after you arrive at the new place. You can claim temporary living expenses, and that's hotels and meals, up to 15 days consecutive. So you can do 15 days in a row on one side of the trip, 15 days on the other side of the trip, or maybe 5 days on one side and 10 days on the other side, but it has to be consecutive days, and it has to be not more than 15 total on either side of the trip. Okay. And that gives you the option to claim those things because they are, again, related to your move. So you had to move, but your new apartment wasn't ready for you for 2 weeks. So you had to, get some Airbnb places to stay and maybe 2 nights at a motel. You couldn't really have a kitchen for those days, so you had to eat out, that kind of thing. And again, we'll talk about receipts and we'll talk about how to prove it. Lease cancellation, yes. Cleaning fees, not so much. So again, if you have to break a lease because of the move, that will be a cost. But if there are a few other things, there are things people try all the time where they go, well, it's incidental to the move. Some of the ones I think that are most common that you do have to be careful about, sometimes if you're moving a really long distance, like across the country, you will have a pre-travel visit where you're looking at homes, or maybe you're going to interviews for jobs. Those costs are not moving expenses because it's not actually connected to the move itself. So that's one thing a lot of people bring receipts in for that you can't claim. But there are other incidental costs related to the move. Can anyone name what some of those incidental costs that are allowable would be? And what I would say is you have 2 places to look for that. One of them is the actual form, and the other one is your textbook. So if you want to get an idea of what is eligible, incidental costs. What kinds of things happen when we move that are expensive, that we don't think about, but if we have receipts for, we can claim? Changing your address. Changing your address on legal documents, driver's license registrations, utility hookups, utility disconnects. If you have receipts for that, you can claim it. Mail forwarding, no. So going to the CRA and paying money for them to forward your mail for a period of time, not a moving expenses. It is explicitly on the list. But getting new license plates, yes. New driver's license registration, yes. Again, changing your address on legal documents. Anything with a fee connected to it, yes, that is allowable. That's what they're talking about when they say incidental costs. Again, if you get something and you're not sure, my favorite page to look at is this one, because a lot of clients will argue with me, but I had to do this for the move, and you're going to say, nope. So mail forwarding costs, no. Expenses to clean a rented home so that you move out and get to keep your security deposit, no. Travel expenses for job hunting in another city, no. Expenses for work done to make your old home nicer to sell, no. Although you might be able to claim if you have capital gains on the home, you can use that to reduce your capital gains on the home. That's outside the scope of this course. Groceries at the Airbnb is probably no, but what I would do instead for that one, that's a bit trickier. When you're talking about meal receipts and simplified meal receipts, you usually have to mean meals you eat out because everybody has groceries. And so if you were living in your home, you would have groceries. So groceries at an Airbnb, I don't think the CRA would allow that. I'm finding from audits that I've done, generally speaking, groceries, no, but eating out at a restaurant, yes. Okay. Because again, if you weren't moving, you'd still be buying groceries. So it's not connected to the move. Okay. Really think about it. Am I doing this thing only because of the move, or would I have been doing it anyway? If the answer is I'd be doing it anyway, it's not a moving expense. That helps me organize it in my head. So a couple of things in here, no. Lots of things, yes. You have to be able to prove it. We'll talk about receipts. And then cost of selling the old home, yes. Cost of purchasing a new home, what's the requirement? There's a special rule about cost of purchasing a new home. You only get the expenses if what? Not if you move in. So if I was a renter and then I bought a home, can I claim the cost of my new purchase on my moving expenses? What's the rule? You can only claim cost of the new home if you sold your old home because of the move. Now, if I had been a renter my whole life and then I moved and I bought a home, I can't claim the cost of the purchase and the legal fees and all that stuff as moving expenses. But what can I claim? I've never owned a home before. I can claim a home buyer credit. So if my client is disappointed because they saw something on the form and they want to put the thing on and they're really upset because they're not going to get in on moving expenses, you can go, well, that's all right. We're going to give you a $5,000 credit for home buyer amount, so you're good. So think about that. If they're not allowed to do something somewhere, maybe there's another place you should be looking on the tax return for the same thing that happened. All right. Any questions about what you can claim or what you can't claim? Again, if you're not sure, look at the form. Is there a place for it on the form? Is it connected to the move? If it's connected to the move, find the category it fits in and double check the first page to see is it explicitly on the list that says no. Think of it this way. If it's on the list that says yes, you can claim it. If it's not on the list, you can't. General rule for moving expenses is there's lots of stuff you can't do, but if it says you can do it, go ahead and do it. Okay, let's talk about simplified versus detailed. So one thing that you'll find when you're doing moving expenses for clients is people do not keep receipts. So nobody keeps receipts. And the fun thing about that is then we want to do moving expenses and we have to prove the moving expenses. So what we do have are simplified rules for two things. One is vehicle expenses and one is meal expenses. So if as a result of your move, you drove your family, you do not have to keep gas receipts and mileage logs and all of those things. You just have to know how far you moved, and there is a flat rate, and you can claim the flat rate without having any receipts at all. You do have to have evidence that you drove the distance. So you're going to have to say, what day did you leave? What day did you arrive? Have an idea about what route they took so that we know how many kilometers it was. Again, you don't have to necessarily have a log to do that because the government can agree if you were in Brandon and now you're in Winnipeg and all your stuff is here, you must have gotten it there somewhere. And if you don't have a different way of getting it there and you tell them you drove in your car, they will believe that you drove in your car and they'll give you the vehicle expenses. Okay. And then meal expenses, you can claim the actual receipts that you spent. So if you have receipts, you can claim them. If you don't have receipts, you can claim a flat rate, which is $23 per meal per person involved in the move, but that means actual person moving, we'll talk about that in a minute, to a maximum of 3 meals per day. Okay? This one gets fussy, so I want to be really, really clear about it. To claim meal expenses, you have to have bought a meal. So if you did not buy a meal, you cannot claim $23 for a meal you did not buy. You don't have to have paid $23 for that meal, but you have to have bought a meal. Okay? So the government can ask for some proof that you were buying meals while you were going. That proof could be a log where you wrote down how many meals you ate. You could keep 1 or 2 receipts if you have 1 or 2 receipts to prove that you did buy meals while you were going. You're going to have to be able to say, yes, we ate a meal, and it has to be reasonable. So again, if you're moving 60 kilometers to get closer to work and you're driving your car, do you realistically think you are eating 3 meals while you are driving? Probably not. So, for that reason, it has to be reasonable. If you drove for 8 hours, you probably had 3 stops for meals. If you drove for half an hour, you probably did not have 3 meals. It has to be meals you actually ate, and you have to be able to justify it. And then, Helene, can you claim simplified even if the meals are less? Yes. So if I ate 3 meals on the road, and each of my meals was $8, I'm going to use the simplified method, because if I use the simplified method, I get $23 for each of those meals as a moving expense. Very, very often we will find that the simplified method is better than the detailed method. It is rare that you will get to say, while you're on the road and you're driving across the country, in Canada especially, there aren't that many places to eat along the road. So most of your meals are not that expensive. $23 per meal to a maximum of 3 per person per day. When I say per person, I mean people who are moving. So for example, I've moved quite a bit. One of the times that I moved, I was the person moving, so it was me moving from one province to a different province with all my stuff I had stuff in 2 cars because one of the cars was full of a harp. So I had a harp in one car and me, and all my furniture in a U-Haul truck. And I actually had some relatives help me with that move. So there were 3 of us in the cars, but I was the only person moving, so I was the only person who can claim meals. That is the rule. Because they weren't moving, they're not on the form. There's no place for them. On the form, you have to say how many family members are involved in the move. That tells you how many meals you can claim. Okay. And then Helene asked, do you have to use simplified for both vehicle and meals, or you can choose? You can choose, but if you choose simplified for meals, you have to do simplified for all your meals. If you choose simplified for vehicle, then you can't do that and add extra vehicle expenses. But you can do detailed vehicle and simplified meal, or simplified vehicle and detailed meals. That's fine. The reason they do that is if we had a choice, we would do simplified for every meal that we spent less than $23, and that one really nice dinner where we spent $100 at a nice restaurant, we would do detailed, and that wouldn't be fair. So you can't pick and choose only the most expensive ones. But what you do is if you have receipts for meals, add them all together, see what it comes up to, then count how many meals you ate, use $23 per that to a maximum of 3 per day, see which number's better, that's the one you're going to do. And more commonly, your clients didn't save any receipts. If they didn't save any receipts, you can't prove receipts, use the simplified method. Okay? So meal expenses, we understand how they work, to a maximum of 3 meals today, but they have to have eaten meals. I cannot stress how important that is. The CRA will audit. They will ask if you have a short move. They're not going to believe you unless you can prove that you ate 3 meals in that move. If you did, and you can prove it, they'll let you take the meal expenses, simplified. But if you didn't, then they're going to disallow probably all of your meal expenses at that point because they won't believe any of them. So ask your client, how many meals did you eat? When you drove that day, where did you drive? When did you leave? Where did you get to? Where did you eat? And make a little chart. Vehicle expenses, if you're going to do detailed, and I'm going to say if because almost nobody does detailed because the record keeping is so complicated. To do detailed, you have to track all of your car expenses for the year and your mileage for the year, and then your mileage for the move itself. So how many kilometers did you drive for the move? And then you take a percentage. And it is very rare that anyone has all of their gas receipts, all of their car receipts, all of their insurance receipts, everything connected to their car, plus an odometer reading at the start of the year and the end of the year, plus a log that says how far they drove. If you have that, go ahead and do vehicle expenses on your drive. Some people do. I did only because I was already keeping vehicle logs because I used my car for work and we used the same car for our move, so I had that information. Most people do not have what they need to claim detailed car expenses. It's not just these are my gas receipts on the road. You probably could justify just the gas if you have gas receipts on the road. I would, and they are more than the per kilometer rate, and they have those receipts. I would go ahead and allow those because the CRA could say very clearly if it's a long drive, all of that gas was for the drive. That one you could prove, but generally speaking, most of your vehicle expenses are not things that are going to be easy to prove using the detailed method. So in that case, simplified. And Helene, does the CRA consider debit expenses on a bank statement as a receipt? No, they specifically don't, because the receipt has to show on it where you bought it, the date you bought it, and what you paid for it. It has to be itemized. If it's not itemized, they don't take it. Because when you go to a gas station, you could buy gas and a bunch of other things. And those other things wouldn't count. So it has to be an itemized statement. So again, very, very rare that I will have a client who is going to claim vehicle expenses who actually kept the information they need to claim the detailed method. Plus, even if they did, most of the time, the per kilometer rate simplified method ends up being better for them. So I think really every time I've ever done this where they do have receipts, in that case, I'm going to add up all the receipts and then I look at the per kilometer rate, and the per kilometer rate is better. If it's a company car, can you claim as long as you don't claim from the employer? We're not going to cover that in this course, but ask me again at the end of class. It's a much more complicated scenario, so I don't want to mix everybody up, but if you're interested in that, ask me after class. Okay, so for vehicle, how does it work? There's a per kilometer rate based on where you left. So what province did you start traveling from? And that will determine your receipts, and then you just have to have per kilometers. How do we know how many kilometers you drove? I love Google Maps. It's wonderful. You don't have to drive the most direct route. You can drive a slightly less direct route, but again, the more away from your destination you're going, the harder it's going to be to say that that part of the drive was required because of the move. But again, when I moved, one of the times I had to move very expensive musical instruments, and it's very complicated getting them across the border. It would have been a shorter drive if I had gone south across the border through the States and back up into Canada, but it wasn't reasonable because I couldn't get my stuff through customs if I had tried that. So we took the northern route. It was longer, but it was related to the move because I had to move 2 harps and a violin. So that was reasonable and connected to the move. So find the route they took, put it in Google Maps, keep a record of what sort of trip it was, because if they get audited, it might be 6 years after the move, and they're going to have to remember, and then claim the per kilometer rate. How do we find the per kilometer rate? Where do we go to get it? If you need to look up a number from a chart, what is the resource you have that is the fastest way of finding anything in this course? Facts and figures. So if you haven't looked at your facts and figures book in detail after last class and this class, it really should be a thing that you are happy to do. I'm going to pull my textbook over here. I'm going to go back in here, and I'm going to say facts and figures, and I'm going to go looking, and I wrote this one down. I think we're looking for figure 20. Oh, that's a checklist, figure 20. And there it is, per kilometer rate for moving expenses, medical travel, and the Northern Residence Deduction. So it's used for multiple things. The per kilometer rate in Manitoba for 2021 was 52 cents. So if you started your move in Manitoba, count how many kilometers, 52 cents for all of them. If you started your move in a different place, you're going to get more or you're going to get less. Generally, try not to move from Alberta to a different place, and do move from the Northwest Territories anywhere else. So the idea is they had to come up with a number. It has to be fair. They're basically saying most people move within their province or to a close place to their province. They take a look at how expensive gas is. Vehicle expenses are from there, and that's how they come up with their numbers. But you don't have to track and go, how many kilometers was I in each province? That is not how it works. It's just where you start from. Okay, 2021. So Manitoba is 62. Is the chart wrong? It's not updated. 2021. So 2022, it's 62 cents. Yeah. So for next year, these numbers will be different. How else can you find it? Well, if you don't have the chart or the chart doesn't have the new information yet, we're going to go to the CRA website. I think I'm going to open a new window for this one just to make my life easier. Give me a moment here. And what you can do on the CRA, so I'm going to say CRA, it can be hard to find. I will say you kind of need to know what keywords you're looking for. If you type something along the lines of meals, vehicle, travel, 21 rates, something like those keywords, you're probably going to find what you're looking for is meal and vehicle rates used to calculate travel expenses. But I will say the exact keywords you need, I've found since teaching this course and looking it up myself, sometimes it can be a bit hard to find. Just keep putting in keywords until you get what you're looking for. And they'll give you the option for this year. So they'll tell you 2021, this is what it is. And then they'll give you previous years as well. So if you're doing a move from a prior year, then you're going to find most of the rates going back as well. Okay. So come up with a combination of words in the search until you see what you're looking for. But the Facts and Figures book is the place I look this one up because it's so fast. Okay, so remember, you can claim simplified or detailed, but not both. So meal expenses, pick one. Vehicle expenses, pick one. If you're doing simplified, you do not need receipts, but you are going to have to be able to justify to the CRA. So what I do, a lot of my clients have no receipts and they want to claim moving expenses. We sit down and we write out a list. What day did you leave? What time did you leave that day? The closer to the move it is, the easier it is for them to remember. So get that data and write it down and put it in their tax file, because they're going to remember it now because they moved recently. 6 years from now, if the CRA asks for information about their move, or even 3 years, they're not going to remember it. They're not going to remember what day they left and what city they landed in and what stops they had along the way. Hotel receipts, you need receipts for. So if you're going to claim living expenses anywhere, you need receipts. If you're going to claim transportation costs, you need receipts. So transportation and storage of your stuff, you need receipts. If you have nothing else, you can still do the simplified meals and you can still do the simplified vehicle. Okay? And that leaves us everything except calculating the income. And Brittany, do we keep copies of receipts for them? We do not keep copies of the receipts. If we did, we would need about 4 times more storage space than we have in our company. We tell clients to keep their receipts. And what I will do, if I have a chart that is, days moved in vehicle and stuff like that, I will put notes in my file so that I have an electronic copy of it so we can reproduce the work that we did if necessary. But we do have to tell them, yes, Brittany, very, very important, they have to keep those receipts. If they want to keep their credit, if they want to keep their money, keep the receipts. And again, you can probably, if you've experienced it yourself, you can tell them these get audited all the time. So expect that you're going to get a letter and that you're going to have to send the receipts in. Good. If you have a client who's going to be traveling in the next, you've found out they've just moved or they're about to move, they just got a new job and they're going to move somewhere else, they'll tell you, my address is about to change. Oh, congratulations. Where are you moving to? Are you moving for a new job? You are? Okay, here's what you're going to keep track of. So I have clients where I know they're planning on moving in the near future, and I will send them a list and say you're going to get an envelope and you're going to stick it in your car, and you're going to keep all of these receipts, and you're going to remember when you're packing to get a receipt for all your boxes, because the more data you keep, the more you can put on the expenses. If you can prove them, you can claim them, and you get a better result. Helene asks, is there a form for the calculations? No, there isn't. You just put the answer on the correct line on the T1M, which again for me means I'm going to write down how many days. The form itself is going to ask you how many days, right? So when you're doing travel expenses, how many nights were you sleeping? You have to fill that in, and then you add all your receipts together. For meal expenses, how many days? And then you know how many household members, how many days, you know what the max is going to be. If you're doing simplified, you can do 23 per meal. They actually 8 to a maximum of 3 per person per day. And then method of travel, you're going to put number of kilometers. If you're doing simplified, you're just going to multiply the rate by the number of kilometers you put here. If you're doing detailed, you're going to add your receipts together and have your log, if you have your log, and put the travel expenses in there. And then we keep track of it ourselves. Okay. Last bit we have to do is net eligible income. So after you've done, yes, they moved, yes, the move qualifies, yes, they had expenses, and we've taken off any reimbursements they got, now we have to find out how much can we deduct this year, and if we can't deduct it all this year, how much are we carrying forward to next year? And that requires you to calculate net eligible income from the new job. If they only had one job in the year, if they moved in January and they didn't work until they got a new job, it's easy because net eligible income is probably going to be the same as net income if they didn't have, other things on the side. But most of the time that's not true. They will have a job before, they'll have a job after, you might have 2 T4s. What you have to do is look at the income from that job, which you're going to get from their T4, and then you have to deduct any deductions that are related to that job. So did that job have RPP contributions? If it did, deduct those. Did that job have union dues? If it did, deduct those. The tricky one is the enhanced CPP for that job. We'll talk about that in a minute. And other employment expenses. Were you working from home for that job? If you were, you can take it off. So you're going to have to figure out all of the deductions connected to that job. Now that can be hard to remember. I don't have the list of what comes off memorized, but I don't need it memorized because it's here. So at the end of the T1M on the 3rd page, they will tell you you're going to take the income on these 2 lines from that job and subtract the deductions on all of these lines from that job. And then that's what you use, and that will give you your allowable eligible income. So you're going to take your allowable moving expenses, you're going to subtract your allowable eligible income, and then you either get all of it, or if you can't use all of it this year, you get a portion of it now, and you carry the rest of it forward, and you claim it next year. Okay? So like I said, in previous years, it was really easy, and then they went ahead and added in the CPP enhanced amount. So then we have the problem of, well, if we have the CPP enhanced amount, how much do we deduct? It depends on if the first job that they had at the beginning of the year included the $3,500 exempt amount or not. So again, if they moved right at the beginning of the year and they didn't have another job, you're going to take the pensionable earnings, you're going to deduct the enhanced amount, and you're going to claim the remainder. Or if it's something that they started at the end of the year and it's the second job they had, if the first job already deducted the enhanced amount, then, they already deducted the exempt amount, the $3,500, then you're going to use all of the pensionable earnings from this one and deduct the enhanced portion. If you're not sure which one to use, it is better to use the higher number. So you're going to take 0.5% of the total. And at the end of the day, we're probably talking about a few dollars difference. So for the purpose of the course, you have to think, is this the only job I'm deducting it from or the second job I'm deducting it from? If it's the second job, take the CPP earnings, pensionable earnings from the new job, take 0.5%. If it's the only job they had, do a regular enhanced calculation, so take pensionable earnings, subtract the base amount, and then do 0.5%. In real life, don't stress too much about this. In real life, usually I just take 0.5% because we're really talking about a very small difference, and usually their earnings are quite a bit anyway, so it doesn't matter. Usually their earnings are a lot more than their expenses, so it's not going to make a difference. Okay. Good. Questions? I'm sure you have many. Practice. The best way to do this is to practice. Do a whole bunch of them. If you want practice, you can create your own scenario and say, all right, I have a person and I have a T4. Use one of the T4s from one of our earlier chapters, right? Imagine that one of the earlier people is there and off we go. How do we claim the carry forward amount? Realistically, it just goes on the line number on the return. I will be showing you more about how to do it with forms when we get to the actual software. But essentially, you are creating, you have a carry forward amount from the year before, and you just add that number onto the line. So you don't need to file a second T1M because there was a second move. You just have the figure from the prior year, and you put it on the return. And if the CRA wants to audit that, they will be auditing the entire move. So then you'll be giving them the information from the first year and the second year, and that's good to go. So essentially, you see what's left over, and that's what you put on moving expenses for the next year as long as they had enough income. Helene, wouldn't the amount be on the notice of assessment? No, this is not something where the CRA tracks the carry forward for you. You have to keep track of your own. They will know about it. They will be aware of it, but it won't necessarily be on your notice of assessment. The client has to keep track of it for themselves. Okay. It's not that common to have a carry forward. Most of the time when people move, one of two things will happen. They will move and all of their income will eat up their expenses, or they'll move at the end of the year and have none. But usually what happens in that case is when they filed their previous year, let's say they moved in 2020 at the very end of the year, when they filed their 2020 return, they probably didn't claim moving expenses at all because they didn't have the new job and they didn't have the figures yet by the time they came in to file their new tax year. So in that case, we do an adjustment, and we do an adjustment to the 2020 year and to the 2021 year at the same time, and then we claim the move all at once. So most of the time, this is not a huge issue because we're doing these by paper anyway. And again, if you don't like doing moving expenses by paper, and you say, why are we making you do them by paper? Because in real life, we do moving expenses on paper all the time. We do a lot of adjustments for moving expenses. Either we're fixing moving expenses someone did wrong, we're claiming moving expenses someone didn't know they could claim, and we do not generate a whole tax return again just so we can have one form. We do these ones by hand. Okay. How do we support it? If you have a reimbursement from the employer, you need a letter that will say what they were reimbursed for, how much they got. That's normal. Most employers who do reimburse moving expenses will have some documentation, and your client will already have it. You want to make sure you have the date of, reason for, and the expenses incurred during each trip. So especially if you're doing simplified, you need to have some written log, even if it wasn't made at the time. Sit down with your client and write it out now. And then any accommodation expenses, you must have receipts. Any incidental expenses, you must have receipts. If you're claiming expenses related to the sale of a home, you must have documentation of what you paid. That will come usually from the lawyer who was helping. So documentation for everything you want to put on there. And then again, if it is time spent at temporary accommodation, if you paid out of pocket for that, you're going to be having receipts. If you're claiming meals from that and you're doing simplified method, you need to have a record somehow of how many meals you ate while you were in temporary accommodation. Okay? Keep the receipts, keep your logs. They do ask for them. All right, it is 10:34. I think, yeah, because we're going on to the next unit, we're going to stop here briefly. We're going to take a 5-minute break. We're going to come back at 10:40, and we're going to jump into the next thing. Okay, so short break, but we have a lot more to do, so we're going to keep going. Give me a check mark if you are back and you are ready to go on the next section. Give me a check mark if you're back and you're not ready to go, but we're going to do it anyway. And I'm going to share my desktop here. Pull out my windows off to the side. And we're going to go into the slides. So we've done the first big deduction. I want to remind you moving expenses are a deduction. And because they are a deduction, they are going to come off before we calculate tax. The value of your moving expenses is your tax rate. So the more money you make, the more valuable your moving expenses will be. We're going to talk about the second one. And this is a very limited deduction. It is working at home due to COVID-19 expenses, okay? Most employment expenses, because this is a type of employment expense, is covered in a different course. So it is more advanced and you need to be a more senior associate. There's a whole course just for the rules for employment expenses. They are complicated. They require a lot of record keeping and a lot of forms. However, when the pandemic hit, all of a sudden, a lot of people had to work from home. And a lot of employers went to the government and said, I don't want to do all the paperwork for all of these people. Come up with a better solution. And what they came up with was a special simplified method of claiming for people who are working at home specifically because of COVID. And because it is so common, we are teaching it in this course as well. Mostly I'm going to focus on the simplified method because once you get into the detailed method, you start aiming towards what you have to do in order to kind of take the rest of the course. But I'm going to touch on it briefly so you know what your options are and you will know whether or not you want to move that client towards a more senior associate or you think the flat rate is going to be the best choice for them. We will talk about what goes into it. And Helene, excellent question. Is this a thing in 2022? Yes, and I had to look this up because last year I would have said I don't know. Right now we have confirmation that working from home COVID simplified methods are only available for 2020, and in 2020 the max was $400, so it was a $400 maximum deduction. And then 2021 and 2022, the maximum deduction is $500. And as of now, 2022 is the last year that they're going to do it. That could change in the next budget. We will find out in the next budget if this is going to continue beyond or not. If it's going to continue beyond, they're going to have to pass legislation to make that happen. So right now, yes for 2020, max 400. 2021 and 2022, the max is 500 simplified. And for 2023, I don't know. So the returns we're going to do this year, the ones coming up will be 2022 tax year. This year we will be dealing with it. The year after that we'll find out. Okay. There are two ways of calculating them. There is a flat rate method, which is the most common one that you will be seeing for the clients you have. And then there is a detailed method, which is available using the simplified rules, but it's a little more complicated. Okay. How do you get it? Let me see if I have that slide here. Okay. In order to qualify, and this is true whether you're doing flat rate or you're doing detailed, to get the COVID simplified method on the return, which is what we're going to do in this course, you have to have worked from home more than 50% of the time for a period of at least 4 weeks, 4 consecutive weeks. Okay, so 4 weeks in a row. and it has to be because of COVID. Okay. The 50% rule is very easy to tell if you have someone who works 5 days a week. If they work 5 days a week, basically 3 of them have to be at home. Or in a period of 4 weeks, 4 consecutive weeks, at least 2 of those weeks have to be at home. Okay. Gets fussier if you get into people who do shift work, or they are like a 4-day on, 3-day off, or a 2 days here and 3 days there. But essentially, you're going to look at how much would they normally have worked within a 4-week period, and within that 4-week period was at least half of it at home. Again, most of the clients that we deal with who are covered in this course, if they're employees, they have some regular amount of employment, and we can tell this fairly easily. If they meet the 4-week requirement, then we don't have to think about it anymore. Now we count the number of days they've worked at home to a max of 250, and you give them $2 a day, and that's it. That is the flat rate method. Okay. You have to remember, because your clients will tell you, every client, I will tell you, I'm sure Nancy will agree with me, every client will say, I worked all year, I get the maximum. And then you remind them that they probably had a vacation, and they definitely had statutory holidays. And you're going to sit down and you're going to go, you worked the entire year, and you never took a day off. And then I go, oh, no, I did have 2 weeks vacation. And then you're going to ask them which weeks did they have vacation, so that you can figure out how many statutory holidays they didn't work on, plus how many vacation days they didn't work on. And you're going to find it's very rare that they actually did 250 days of work. Okay? You have to take the number your client gives you, but you have to investigate it a little bit. What I love, and we did this a lot in the office, is there are some very handy online free calculators of how many working days exist in Manitoba or whatever province your client is in, and you can put in the calendar year, and you can say, assuming a 5-day Monday to Friday work week, and from this date to this date, how many working days were there? From this date to this date, how many working days there were there? Or what you can do is you can say, how many working days were there in a year in Manitoba? And then if they had a regular 5-day work week and they took 2 weeks of vacation, subtract 10 days from that. That's how you're going to get the number for 250. I will tell you, I think last year, because I did this for many clients, the flat rate method, of the clients I did it for, I think maybe 2 of them actually got the max. And Brittany, yes, if they worked on stat days, then they worked on stat days. And if they worked from home on those stat days, they worked from home on those stat days. If your client is willing to, they're welcome to sit down with a calendar and write down every single day they worked from home and count them for you. So I have some clients who will do that, and I'm happy to take that number from them. But I will tell you, the automatic gut reaction is I get the full credit because I worked a lot and I worked from home. And everyone worked a lot, but 250 days generally means no stat days, no vacation days. You just worked every single day. If that's true, you can get the maximum. If it's not true, you need to dig into it a little bit. Okay. If you're going to claim the flat rate, can someone in the chat window tell me what form number we're going to use? T777S, a T777S. So this is a simplified employment expenses form. Okay, and I'm going to see if I can pull one up for you here. So I'm going to go to the CRA and I'm going to type C777S, not to be confused with a T777. So when you pull up a T777S, you could go to the wrong place unless you're being very careful. Make sure you do find the one that has an S on it. Okay, and the very simple thing is if you are doing a T77S, all you're going to fill out is 2 lines. You're going to put the number of days to a max of 250, multiply it by 2. That number goes here. Put that number on the deduction line, which is line 22900, and you're done. You do not need any other documentation at this time. Okay? What you might need if you get audited or if you get a request for info is a letter from your employer saying, yes, they had to work from home, and some calculation, some proof of how you calculated the number of days you worked from home. But that's it. You don't need any other signatures or documentations or forms from your employer. You only need a T77F and you're done. Okay. The idea is they did this so that A, the employers didn't have to fill out 6 million forms for all their employees, and B, employees did not have to keep receipts and calculations and all kinds of other things. It is simplified, and it kind of is fair. It solves problems for the government. They don't have to audit everybody's receipts. If you can imagine the government trying to keep up with an audit for, normally they'll get a certain percentage of returns, a very small percentage will have employment expenses. And we went from that to almost immediately, almost every employer who could do it having their employees working from home. So it would be unreasonable for the government to audit that if they had to look into every detail of every receipt of every person who claimed it. So the idea was, let's make this fair, let's make this simple, everybody gets $2 per day, figure out how many days you work from home. If your client was already working from home and now it's COVID, they will not qualify for this. If they were already working from home, they should be claiming employment expenses the normal way, the way they always did, which is with two different forms. There's a T2200, which is not a T2200S, it's a different form, and a T777, not a simplified one, with all kinds of receipts and signatures. They're going to continue to do that. It doesn't mean they can't get employment expenses. It's just they can't use the simple method. They have to use the same method they've always used. And they have to qualify for it the same way that they've always qualified for it. Okay. Now, we do have some people who are working from home and they would like to use the detailed method because when they started working from home, they had more expenses than the average person, in which case they do qualify if it's because of COVID for the simplified method, as long as they still worked 50% at the time from home for at least 4 consecutive weeks. So it's the same rule that it was before. What makes it complicated is we now need to calculate a little bit more to say how much they can claim. So what they're going to do is they're going to add all of the expenses related to the space in their home that they're working in and supplies. Supplies, again, think about our employment expenses that we know for the refundable school credit. Supplies are things that get used up. Supplies are not physical things that stick around. So supplies will not count as the new computer you bought to work from home or your ergonomic desk chair. I'm thinking about all the things my clients have asked me to put on their working from home expenses that I had to say no to. It's not going to be the new printer that you purchased. It's not going to be the new desk that you bought because you wanted a nicer office at home. Those things are what we call capital assets. They last. Those are not included. Supplies are things you use up. It's your paper, it's your printer ink, that kind of thing. Okay, I'm going to go to the book for this because I actually think the textbook is really good on this section. So I'm going to pull that up a little bit. Detailed method, what kinds of things can you claim? So if you rent, you can claim your rent. If you have utilities, you can claim electricity, heating, water, and internet access fees. This is new. They used to be really fussy about internet fees. They had special rules about internet fees. Everyone is agreeing internet is a thing that you pretty much have to have if you're going to work from home now. So does not include connection fees or the leasing fees for a modem or router, but the actual fee you pay for your internet monthly you can. You have to have your bills for the whole year for all of these things. And then the portion of the condo fees relating to utilities can be claimed, specific utilities only. If it's not separated out, you're not going to be able to claim it. And then minor repairs to the workspace only. So minor things for the workspace only. Major repairs, things that affect the value of the home, no. Okay. Insurance, if you are a commission employee, if you pay commissions, you can add in your insurance, home insurance. If you have commission income, you can add in property tax. But then You can only claim your working from home expenses against your commission income, not against all your income. So you're going to have to decide which is better. If you get into this and it starts getting confusing, go find a senior associate who deals with employment expenses all the time. They can help you. The tricky bit is you cannot claim 100% of those costs. You can only claim the percentage of space in your home that you're using from home, and it has to be prorated by the amount of time you're using it for space. And Brittany, I'll get back to that one, okay? So let's concentrate on this, but I will answer your question because it's a good question. So when we're talking about the space, if you have a separate workspace that is only used for work and is never used for anything personal, so maybe your home, you set up a home office, you close the door, you go into the office to work, and then you close the door and no one uses that room for anything else. In that case, you're going to prorate all of your home expenses based on the floor space of your home. So if you have one room that's being used as an office and it's only used as an office, and you have 6 rooms total in your house and they're all about the same size, you'll get to claim 1/6 of your expenses, the detailed expenses, as employment expenses under the COVID method with the simplified forms. Most people, that's not what happened. So for COVID, most people kind of borrowed their dining room table and they turned their dining room table into an office / school room for the kids / also we eat food on it / whatever other thing. In that case, you need the floor space of the actual part you're using for work. So if you're in an open concept kind of dining living room scenario, and you can find pictures of this, the CRA has diagrams, you're going to calculate the size of the desk space to the back of your chair. That will be the percentage floor space. And then you have to prorate it again by how much of the time you're using it for work. So if you work for 40 hours in that little part of your house, and the rest of the time you're not using that for work, then you're going to take 40 and divide it by, I believe it's 168 possible hours in the week, which works out to usually about 0.2%, no, 2%. And then you're going to multiply that by your floor space. And that's how much you're going to get. And because that is the rule, most of the time, the simplified method will get you more money. You're limited to what you can claim, and you're limited to how much of what you can claim. And that's fair because everybody else is not allowed to claim their rent and their utilities and all of those things while they're away at work. And so the reality is your home is mostly used for personal reasons, so you mostly can't claim your home. And again, there are really good diagrams on the CRA. So if you have a client who's having difficulty understanding how this works, there are examples you can find from the CRA website that show how they will accept the calculations. And then you can say, I would like to give you lots of expenses, but this is why I can't because the CRA has this rule. Okay, you're going to see examples of it here. So we've got Sam. Sam worked from home. So 40 hours a week divided by 168 is 12%. And then we're going to look at the actual floor space. And then that's going to be, so the floor space was 12%. 40 hours divided by 168 times the 12% worked out to about 2.9% for them. What you can do, if you have these numbers from your client, is go ahead and do the calculations both ways and see which one is better. I did have a client who had a separate home office. They took a room, turned it into a home office, even though they had a really small apartment that became their workspace. And there they had to work from home all year. They were a teacher at one of the universities and everything had gone online. And we did the detailed method for them because of COVID, and it was a lot better than the simplified method. So don't assume it's not, but if it is, go ahead and use the flat rate. And I would say most of the time the flat rate was. The examples are in here of what you can claim. So supplies you don't have to prorate, but you have to have receipts. So if you're going to do supplies, make sure you have receipts. Things you cannot, everyone will ask to claim these: lamps, floor mats for your chair, garbage bins, computer accessories, calculators. They bought a second screen, they bought a headset for their computer, all of those things. They had to have a shredder. A lot of people had to buy shredders last year. It was really hard to find shredders in the stores once we all started working from home. Those things you cannot claim, you cannot add them in. And again, there are examples for how to do it here. I'm going to get two that I want to talk about as well. Cell phones. Everybody wants to claim their cell phone as a home office expense because I had to use my cell phone for work. Technically, you can claim a cell phone if it meets this test. And I've highlighted part of it because as soon as I get to step 3, it does not apply to anybody. But we're going to talk about it. So first, the cost of the plan must be reasonable. That's fine. Everyone has a reasonable plan insofar as anything is reasonable in Canada. We have very expensive cell phone costs in Canada compared to other countries. If it's what is normal, then it's reasonable. It has to be portioned in some way between employment and personal use. So you could have your client keep a log, how many minutes do they spend on their phone for work versus how many minutes do they spend on their phone at home. No one does that, but even if they did that, the third test is the one that kills it every time. The taxpayer has to show how many minutes of data they consumed while they were working and the cost of those minutes. So in the olden days with cell phones, you paid a set fee based on usage, and you had a daytime use fee and an evening time use fee, and it was all broken down. And now we have unlimited plans. And unlimited plans mean if you use 1 minute, it costs this. If you use 1,000 minutes, it costs the same amount. There is no way to break it down. And if you can't break it down, you can't claim your cell phone. So I will tell you, of every person who's asked me to put a cell phone on a return, in the last 4 years, I have not had one person who can meet this third test, and we have not been able to claim cell phones. The reality is we are all paying the same amount whether we're using our phone personally or we're using it separately. And Leon, if you have a separate work phone, then yes, if you have a separate work phone and that phone is only used for work and you're paying for it, then you can claim employment expenses for your phone. That's not very common right now. Most people just use their personal phones. And because most people have personal unlimited plans, that's very hard not to have a personal unlimited plan right now. Most people do not qualify. Okay, so this is the test, and most people will bring you their cell phone receipts, and you will say, thank you very much, and there is no breakdown on those receipts, and you cannot use them. But there we go. Okay. The other thing I want to say is we had a lot of situations where you would have multiple people in the house all using the same workspace for the same hours while they were working from home. You can't double dip. You can split it between people. If you can split it, so maybe one person gets half of the floor space and the other person gets the other half of the floor space, in which case you're good to go. But you should be careful not to double dip. And you can't mix the detailed and the simplified method, so you have to pick one. Okay? If it gets really messy and complicated, go find a senior associate who works with employment expenses, and they will have more experience with how to navigate that. So I've had some really complicated ones where I've got one person who's self-employed and they have a home office, and they have another person who had to start working from home in the same house, but they were using the dining room table, and we have to sort of sort everything out and make sure we're not double and triple claiming the same expenses on 2 returns. It can be done, it's just a headache. So prepare yourself to do the simplified method. Understand the detailed method so that you can determine if it would be beneficial, and if it's beneficial, you're going to go ahead and can both spouses claim the simplified method? They can if they are using different spaces in the house. If they're using exactly the same space, it gets a little fuzzier because you want to make sure you're not double dipping again. But most of the time, you're not sitting on top of each other while you're working, so you have 2 separate spaces, and you're usually working about the same hours of the day, so it is possible for both spouses to claim the simplified method. If it's straightforward, it's straightforward. We all incurred more costs because of the pandemic. This is allowing us to reflect that on the tax return. Okay. Last thing, if you are doing detailed method, you need more documentation. So to do the detailed method, I'm going to go back to my form now. We're going to use the second part here, and I really wish that they had not said this, because as soon as the clients see that, they go, oh, I can claim my cell phone, and then we have to go back to what the rule is, and we go, you could claim your cell phone if, but no. But there it is. So you have eligible and non-eligible expenses. You're going to tick these off, you have to say yes to this. You have to get a T2200S, not to be confused with the T2200, which is a different form. You get a simplified T2200, and you have all your supporting documents. You don't have to send the documents in with the form. You just have to have them. And then you're going to do the calculation here with your proration. And of course, you cannot claim more than the income you made. So if your working from home costs were more than your actual income for the job when you were working from home, you are limited to the job you're working from home. You can't have a net loss because of this. Are there any questions? I know that's a lot. For the purposes of this course, we're probably going to tell you how many days they worked from home. We might give you the information you need for the detailed method and ask you to pick if you're going to do detailed or simplified. But most of the time for this course, we're going to assume that your client is going to be more eligible for the flat rate. Yes, the adult child renting from parents. So the adult child renting from parents, if you are paying rent and you want to claim rent, you can, but you will need a receipt. And that means if you have a receipt, your parents had better be reporting the rental income. So if you want your parents reporting the rental income, because it's income for them, then yes, get a receipt from them and you can claim it. I don't have a lot of situations where that happens because most of the people who are renting from their parents are not paying market rate. So a lot of people will, let's just say, contribute to the family expenses, and that's a little bit different. Okay, but yes, excellent question. Okay. So we have done working from home, workspace. All employees can claim rent. You cannot claim mortgage. If you own your own home, don't consider your mortgage to be equivalent to rent. That's not how it works. If you're renting, yes. If you own your home, congratulations. You own a home, you have an asset. Good for you. Utilities, maintenance and repairs, but nothing, you can't decide to redecorate your entire house and claim that. And it is important to remember if you're doing detailed and you're claiming maintenance and repairs, it has to be maintenance and repairs on the area that you're working in. So if you are working in an office space and you renovate your kitchen, that's not going to count. But if you are renovating your office space, you're repainting because now all of a sudden you're going to be on Zoom all day and people are going to be looking at your wall that had a hole in it a minute ago, that will be a maintenance and repair issue. If you need to replace your light bulbs because you need better lighting in your workspace, that will be a maintenance and repairs kind of thing. Okay. If you're working in the office and you have to fix the heater that's in the boiler room, if it's related to heat, that one gets trickier. You would probably be able to claim that, but at a prorated rate. And again, when we get into those questions, you really do want to find someone who does employment expenses so they can take a minute to look up some of the fussier rules that we teach in another course. But I'm pretty sure that one essentially we'd be able to take a portion of the maintenance and repairs cost that is related to your workspace. Trickier if you're buying a new furnace. So if you're buying a new furnace, the rules get more complicated. So again, when you get into these questions and it's beyond what we do in this course, go get some help. And then if you are a commission employee and you're doing detailed method, you can add in your home insurance and your property taxes, but you then can only claim expenses against your commission income, not against all your income. Okay? You can carry your expenses forward if you can't use them this year, if you're doing the detailed method only, okay? But most of the time that's not relevant because most of the time your expenses are less than your income. And Brittany, you're the queen of poking holes in rules that everyone thinks are concrete. Yep, that's one of the things I like about tax. We like to come up with complicated situations and then figure them out. Because tax returns are a reflection of life, and life is messy. So tax returns are messy and interesting and fun. All right, and then supplies are things, as I say, they get used up. And cell phone can be claimed, but restrictions apply. Think about the restrictions. Very, very, very rare right now. that you'll find someone who qualifies, unless, as I say, they have a separate work phone that they are paying for. Their employer's not paying for it. They're not being reimbursed for it. If they're paying for a separate phone, then yes. Okay, which method should be used? We have a really handy checklist. You can find this checklist in your textbook. You're going to have it in the PowerPoint slides when we send those to you at the end of class today, and it's in your Fact and Figures book. So which one should you use? You can use this chart to determine what's the best. Or if you're comfortable with the calculations, I do this on the back of an envelope all the time. This is I have a little sticky note on my desk, and I just quickly kind of scribble down what's my proration. Is it personal use or is it sole use? Do they have a separate office or is it a shared space? How much is the floor space? And then I make a list of which expenses they have receipts for, and I do a quick calculation, and then I see if $2 per day is better. All right, so let's take a break. We're not going to because, we have to keep going, I think. Wait, give me a second here. Yes, we're going to keep going for a little bit, and then we're going to come back and do provincial, okay? So tax calculation. We have now learned how to get total income, how to take off deductions. Deductions now include everything we've done up till today, plus moving expenses, plus working from home. Okay. Then you get your net income. Then you're going to take off a few more deductions. Then you get your taxable income. Then you calculate your tax, which you all know how to do because we did it in Chapter 1. You're going to find what tax bracket you're in. You're going to put it in the right column. You're going to get to the bottom of that column. It tells you what federal tax you owe. Then you're going to calculate your non-refundable credits, which I taught you to do last class. You're going to take 15% of those. You're going to use that to reduce the tax you have to pay federally. Then we're going to take off some additional things that I'm going to teach you later, plus a little bit that I'm going to teach you today, political contributions and LSVCC. Then we get to federal tax. So political contributions are a non-refundable credit, but they're not a 15% non-refundable credit. They have their own rules about it. And LSVCCs is another non-refundable credit, still non-refundable, but they have a different rate for rules for what goes on. And so we have talked about those. They come off afterwards. Still reduce tax down to 0, but they don't go into the negative. Then we get to put the federal tax. If you have anything left, that's the federal tax you're going to pay for the year. And that goes on to step 6. And it says line 140, but it's actually line 42000. Okay? This is what it looks like. You're going to get your federal tax. Then you're going to take off a few things I haven't taught you yet, like dividend tax credit. I'm going to teach you that later. That's Chapter 7. Very, very quickly, political contributions. Political contributions. If you contribute to a federal political party, an official federal political party, you get extra money back on your tax return. You don't just get 15% back, you get more for some of it. So can anyone name some federal political parties we have in Canada? Let's see in the chat window. Federal Liberal Party, yep. A couple more. Conservatives, yep. Green Party, NDP. These are the big ones that we see. Bloc Québécois. If you'd like to donate to the Bloc Québécois, you can. It is a federal party. We have the new PPC party. There are some smaller ones. They have to be officially registered parties. If they're an officially registered party and they're federal, you can claim a federal political contribution credit. You have to have a receipt, and it has to be in the year. Okay? And you can claim it for yourself or your spouse. So if you paid for it, but you don't need it, even though your name is on the receipt, your spouse can put it on their return if they want to. How much do you get? For the first $400, 75%. For the next chunk of money from 400 to 750, an additional 50%. And then every dollar over that, you get another 33.3% to a maximum credit of 650. Okay, so the most you're going to get it for is if you make a donation. Oops, I got to go back here. If you make a donation for, where did it go? Oh. If you make a donation of $1,275, you're going to get the max. Okay. Every dollar over that, You must really like the party. Good for you. It's not going to show up on the return. So how we calculate this is on our federal worksheet. So this chunk that is on the page right here, if you need to know where to find it, look for it in your federal worksheet. The number you get at the bottom is going to go on to line 41000 of your return. Okay. This one is federal only. So if you have contributed to the provincial Liberal Party or Conservative Party or NDP Party or whatever other provincial party exists in your province, you are going to have to look for the rules provincially, but you're not going to claim that receipt federally. This is only for federal parties. Okay? It's one of the few non-refundable credits we have that you don't just get 15% for. You get more. So if you have a client coming in and they want a nice big tax credit, this is one of the most valuable tax credits they have. The first $400 you give to a federal political party, you get 75% back to deduct against your taxes. It is a non-refundable credit, so you have to owe tax for it to be beneficial to you, but it's a very nice non-refundable credit. Okay? And then labor-sponsored funds tax credit. I'm going to talk more about this when I get to provincial because it's more relevant to us. There used to be, so labor-sponsored venture capital corporations is a special type of corporation that exists. It used to be something you could register federally. That no longer exists. So this has gone away, and there are no more new LSVCCs that are registered federally. Most provinces do not do this either, but Manitoba does. So Ontario, Prince Edward Island, Newfoundland, Northwest Territories, Nunavut do not allow LSVCCs to be registered. Alberta does, but it's being phased out. Manitoba still has this. They're not common. I haven't seen one, but they do exist. And so the way that it works right now, so when I started teaching this course, they were basically everywhere across the country, and it would have rules for matching and not matching. The way it works now is if you have a Manitoba credit, you put it on the Manitoba return, and then you get a matching federal return. The official rules for the federal portion is you're going to get 15% of the actual amount that you purchase. So when you have an LSVCC, you're buying shares in a special type of corporation, you can claim 15% federally to a maximum of $5,000. So you get maximum $5,000 credit. Because there are no more federal LSVCCs, essentially what's going to happen is you're going to find out what the provincial one is, and then because the provincial one actually has a smaller limit than the federal one, whatever's on your provincial one in Manitoba will match what's on the federal one. Because it's not common, that's really all I'm going to say about it till we get a bit on the province. So for your purposes, understand that if it's a Manitoba LSVCC, you're going to figure out what goes on the Manitoba slip, put the same amount on the federal slip. Okay, we are going to take a break here. It is 11:18. I come back at 11:23, okay? Okay, I know we're having short breaks today. We still have a lot to do. I'm going to do as much today as I possibly can, and then we're going to finish the rest of it next week, okay? So give me a check mark if you're back. We're going to jump into the really fun stuff, which is mostly provincial things now, okay? I'm going to assume at this part that you have tried this out with your chapter review problem. So if you've done your chapter review problem, you have now had to go through. Remember, when you get to the forms and you're doing your final calculations, you're not going to need every single line on here. If it is a line that does not apply to what we've learned in class, leave it blank. But you have to start looking for the lines that we are now talking about. So we're going to get in here. You're going to say federal surtax, T2203. I've never heard of that form. That's not going to be relevant to me. Foreign tax credit, T2209. I've never heard of that form. That's not relevant to me right now. Recapture of investment tax credit, never heard of that form, not relevant to me right now. But then you're going to get down here and say federal political contribution tax credit. Oh yeah, my client has one of those. So then you're going to go here and you're going to use the federal worksheet. You're going to get the figures you need. It's going to tell you what goes on line 40900, which is a reporting number, what goes on the tax return, which is the actual credit, and so on. So you're going to start working your way through the slightly scarier looking parts of the forms, and the more you practice it, the more comfortable you are. From this point in the course on, you are going to be finishing every tax return you do. Okay, so you're going to get your federal tax, calculate the federal tax, take your non-refundable credits off, deduct your other credits, and that's going to tell you how much federal tax you have to pay. You're going to get a total payable line there. Add in your provincial one, and you're going to have that one there, and then you're going to have less total credits. And Brittany says, have I ever had a tax return where every single line was used? No, I think that might be impossible, because some sources of income you only get if you don't have other things. So for example, some sources of income you're only going to get social assistance if you don't have other types of income. And so because of that, there's no tax return I can think of that would use every single line. But I have definitely had some tax returns where I've used an awful lot of lines and some very complicated lines. And I've had, for me, because I do very complex returns, I've had some tax returns where when I put everything together with all of the pages that I need and all of the schedules and everything else, if I was to do a paper return, I'd be looking at 80 or 90 pages for that return. That can happen. It can't happen in this course. So don't worry. We're not going to get that complicated here. You are going to notice you're using more paper. So by the time we get to today, your stacks of paper are going to start getting bigger, especially because of what we're going to do right now, which is we're going to talk about provincial. So we get all the way to the end of federal. We determine what our federal tax is owing after we've taken off our deductions, after we've taken off our non-refundable credits. Then we stop, we calculate everything again for the province, come up with a provincial figure. Then we're going to do our refundable credits, and at the end, we balance everything out, and we either get a refund because your client has paid too much tax to the government, it's going to get some of that money back, or you're going to have a balance owing, and they have to pay a little bit more. If you get a refund, it goes on the refund line 48400. If you have a balance owing, it goes on line 48500. The tricky bit for right now is the provincial tax. So for this, I do not have slides, and you're not going to get any slides from me because there aren't any. What I have is a very handy textbook, and the textbook that we're going to use for this course is the Manitoba Provincial Tax Supplement. Make sure it says 2022. And again, we're not doing 100% of this today. We are doing a portion of it, and then as we add federal complicated things, we're going to then come back to this book and we're going to look for if there's a matching or a similar provincial issue within that complicated topic. So for today, we're sticking with what I would call a very basic return. We're talking about employment income, employment-related credits, and personal credits only. Okay. Right off the bat, we have Manitoba tax system. It tells us that what we're going to do provincially is the same thing that we do federally. We take the taxable income figure from the federal return, we put it on the top of our provincial form, we calculate our provincial tax owing, and then we give provincial credits. We have non-refundable credits, and we have refundable credits. Deductions happen before we get to taxable income. So deductions have already happened. When we get to the province, we're looking at provincial non-refundable credits, and then in Manitoba, we have some provincial refundable credits as well. Okay. Again, this book is for everyone taking any course, whether it's a level 1 course or a more advanced course. So some of the things in here, tax on split income, minimum tax, we're not going to cover that in this course. We're going to start with a basic return. What I do want you to do with this is start mirroring. So if you saw it on a federal form, when you look at the provincial form, does it look the same? If it does, come here and find the rule, because some of the rules are the same and some of them are different. I'm going to start with tax rates. Very briefly, we looked at this all the way back in Chapter 1. Manitoba has 3 tax brackets. Federally, we have 5. Manitoba has 3. The lowest is 10.8%. Can someone tell me, either who's read this or who's looked at the forms, What are the non-refundable credits in Manitoba worth? What are the provincial non-refundable credits worth? Federal non-refundable credits are 15%. What are Manitoba provincial non-refundable credits worth? 10.8. Yep. It works the same way. Your non-refundable credits are equivalent to your lowest tax bracket. So if that goes up, then the non-refundable credit will go up as well. Okay. Which non-refundable credits do we have? Well, I have highlighted out the ones you already know about. Basic personal amount, much lower than the federal one. We have a fairly low basic personal amount in Manitoba compared to other provinces. For 2021, it's 9,936. You'll notice we don't have anything fussy with that one. So remember, federally, we had to worry about the top two tax brackets and change the numbers. In Manitoba, the basic personal amount is the basic personal amount for everybody. We're going to come back to these ones, age, spouse, elder dependents, infirm dependents. We'll talk about that when I teach you the federal ones. CPP, whatever's on the federal form, make it the same as the provincial form. So the base amount of CPP is going to show up on the federal form and on the provincial form. The enhanced amount will not show up on the provincial form anywhere, okay? Just the base amount. EI, whatever's allowed on the federal form for EI premiums is also going to show up on the provincial form. Volunteer firefighter amount we're going to come back to, but there is a $3,000 credit for that and a $3,000 for search and rescue. Everything else here I'm going to talk about later. Family tax benefit I'll talk about today. And again, the eligibility is the same. So if it's on the federal form, it should also be on the provincial form. I want you to notice some things are not there. So federally, we have a Canada employment amount. Provincially, we don't. Federally, we have a first-time homebuyers amount. Provincially, we don't. So what I do is I go to the federal form, I make a note of everything I have, I go look for it on the provincial form, and if I don't see it and I think I might be missing it, I check my supplements book. And I go here and I go, oh, no, it's not there because it doesn't exist. Okay? All of this happens on one form, and that form is our basic form. So this is our how we calculate tax form. So I'm going to pull that up for you and show you where you're going to find this. You have fillable forms, but the fillable forms are generally federal. So if you need to find province-specific forms, look up a tax package on the CRA and make sure you're in the right province, because every province's forms will be different. They will have different lines, they'll have different rules, and they'll have different numbers. If you are doing a return for a different province, you might have a taxpayer who is resident in a different province and now they've moved to Manitoba and you have to do their return. You should go find the supplement for that one and look to see if there are any special rules that you might not know about because they might be different. I'm going to handle Manitoba in this course. If you have questions about Manitoba, that's what class time is for. If you have questions about other provinces, you can ask, and if I don't have time to talk about it, we'll talk about it after class. I actually have a lot of clients in a lot of different provinces, so I have to keep up to date on a lot of them. And if you're working in a place where you have military members, you're going to get comfortable with a lot of different provinces because they move all the time. And sometimes they don't file their returns for 10 years. And then they come back and they worked in the military and they want to do 10 years of returns. And you have to find out what province they lived in each of those years and figure it out. So we do actually look at other provinces all the time. The nice thing about this course is I think the Manitoba ones are some of the most difficult ones. So if you can handle Manitoba tax and you'd have to do a different province and you're looking at Alberta, you're looking at Saskatchewan, you're going to find it very easy. All right, so federal forms are on the left side, provincial forms on the right. I'm going to start by opening an MB428. I'm going to open it here. And if we're looking at an MB428, you're going to see take the taxable income from the federal return, put in the bracket. We're going to enter the basic personal amount here. We haven't taught you these ones yet. We're going to enter CPP. We're going to enter EI. If they qualify for the volunteer firefighter and search and rescue, we're going to put them in here. You're going to add them all together. We're going to talk about some of these ones later. I haven't taught you these ones yet. Family tax benefit is the one you're going to forget about. We're going to come back to that. It goes here. Add them all together, and you're going to take 10.8%. And then just like the federal form, After you calculate that, there are a few extra non-refundable credits like political contributions, like LSVCC. They're going to come afterwards because they have special rates. And then at the bottom, you're going to see, do you owe any Manitoba tax? And generally speaking, the answer is yes, you owe a little bit, or some, or a lot, because we have pretty low non-refundable credits and pretty low tax brackets. So pretty small tax brackets, a lot of people pay more tax in Manitoba. That number goes on to the return. What we do have in Manitoba, which is different, is we also then have refundable credits. So Manitoba has a large number of refundable credits. So you might pay more tax officially on the tax line, but then you might get more of that back as a refundable credit. So we're going to talk about that as well. Okay, make sure you know where to find the forms. And again, every review problem you do, I'm now expecting you basically to do a full return. A full return means provincial forms as well. Okay. So I said we talk about volunteer firefighter. Volunteer firefighter works exactly like the federal form. The eligibility is the same. It is a $3,000 credit. The difference is if the volunteer was not resident of Manitoba at the end of the year, then you don't get this, even if you were working as a volunteer fighter in Manitoba. And the reason for that is if you weren't a volunteer, if you weren't in Manitoba at the end of the year, you're not filing a Manitoba form. If you're not filing a Manitoba form, you can't put a Manitoba credit on it. So if you're filing an Alberta form and you were a volunteer firefighter in Manitoba and now you're in Alberta, you're going to have to go look at the rules for Alberta. And that's really all this means. So generally speaking, if your client was in Manitoba for the whole year and they were a volunteer firefighter federally, they're also a volunteer firefighter provincially, and they get a $3,000 credit. You don't have to worry about the income because you already dealt with it on the federal form. So all you have to think about is if you see a $3,000 volunteer firefighter amount federally as search and rescue or firefighter, you're going to do the same thing provincially. Okay, that's it. Nice and easy, comfortable, good. We're going to keep going. So we've talked about all the credits that match, that are easy. I'm going to skip a few things. We're going to come back to this. So you're going to see a fitness amount. I'll talk about that when we get to families. You're going to see an arts amount. We're going to talk about that when we get to families. Caregiver, we're going to talk about when we get to medical expenses. So you're going to find by the end of this course, we've done a big chunk of this book. In addition to our whole federal textbook, we have a lot here. The one I want to talk about next is the Manitoba Family Tax Benefit. This is specific to Manitoba, and it is the thing that we forget the most. So as you are doing this, I want you to do an MB428A for every return that you're doing an MB428 for. If you're doing provincial tax in Manitoba, you need a 428 and a 428A. In real life, if I had to do paper returns, there are some clients where I know just from looking at their family size and their income that I can skip this. But you don't know that yet. You don't have that experience yet. Because you don't have that experience, you're going to miss a few. So it is a family benefit, but it has a lot of pieces to it. I would like you to practice it. Practice it every time. This is your one opportunity to get really comfortable with this form. If you know this form, it's going to solve a lot of problems if you actually have to do tax returns in an office because it can get a little messy. How does it work? It's a tax credit, so it goes into your tax credit line. It starts with a base amount, and it is calculated, as I said, per family. So because it's calculated per family, there's going to be a determination for which family member is going to claim it. I'm going to come back and talk about how we decide who claims it when we get to families. So that portion of it we're going to deal with later in the course when we've talked more about what a family is. For now, you're going to calculate this for every client you do, and you're going to assume that they're the person claiming it. You get a base amount for the taxpayer. If they have a spouse, a common law partner, or an eligible dependent, you're going to add a $2,065. I haven't taught you the definition of those yet, so it's not really going to apply. And then for seniors, we'll talk about that when we get to seniors. We're going to talk about disability when we get to disability. We're going to talk about disabled dependents when we talk about dependents and disability. So most of this form, you're just using the first line for right now, okay? And then all of these special rules here, we're going to talk about when we get into the more complicated stuff. The way that the form works is you get a basic credit. That credit is reduced by your family net income, and then it goes, whatever's left over, if there's anything left over, it goes on the return as an extra credit. Okay. Both the taxpayer and their spouse can claim the tax credit, and it only gets complicated when you get into eligible dependents, complicated dependents. Then there are special rules for who claims what parts and how we share it. Okay, that we'll get into later. So let's start with the base. Before we make it really complicated, let's talk about just the simple scenario, and I'm going to open here in MB428A so you can see what it looks like. Okay. So again, I'm going to my main page. I'm going here. For simple families, you're going to have a base amount, and that's it. We're not going to talk about dependent spouses until I teach you what that line number is. So we haven't got that. You're not going to have eligible dependent yet. I haven't taught you about them yet. We're not going to talk about age yet, so that's not going to be relevant. We haven't talked about disability in children yet. That's not going to be relevant. It will later. I promise we'll do it later. For now, just the base amount. Then you're going to take your net income, multiply by 9%, and see if there's anything left over. If there's anything left over, it goes on to line 61470. It is the last of your regular non-refundable credits on your form. So you're going to do your personal amount, you're going to do your CPP, you're going to do your EI, you're going to do your volunteer firefighter if you have one, and then you're going to do your family tax benefit at the end. Okay? Do this form every time. You will learn as you're doing it which net incomes become too high so that you're not going to get it. If you know for a fact that your net income, 9% of it is more than $2,065 right now, then you're not going to need it. You're not going to miss anything. I'm going to say do it anyway because as I start making the families more complicated, that $2,065 is going to get much bigger, and then we're going to have a range where we're going to need it. Are there any questions about this part of it? Hopefully, mostly I'm going to say just remember it exists. Try to remember to use it. We'll add to the rules as we make our family situations more complicated. All right, I'm going to skip the next couple. We have tuition, we have transfer of tuition. Adjustments to tax is not going to be relevant for this course. It deals with other things. Political contribution does matter. So just like you can contribute to a federal political party, you can also contribute to a political party. To get this credit, you have to contribute to a Manitoba political party or candidate. Manitoba is important to remember. We're filing a Manitoba return. It has to be a Manitoba donation. How much you get for Manitoba, it's nice. It's the same calculation as it is federally, but there is a maximum credit of $1,000 in Manitoba. Okay? So if your eligible contributions are $2,325, you're going to get the max $1,000. And you're going to calculate this on the worksheet for Manitoba. So just like the federal form, our regular tax return form has a federal worksheet. Our 428, our Manitoba tax form, has a Manitoba worksheet. So you can do the calculations the same way. Okay. I'm going to do a really quick poll here just to see if you think you know how this works. So bear with me while I open this one up, and we're going to test your knowledge and understanding. We're going to have a taxpayer who lives in Alberta. Lived in Alberta at the beginning of the year, contributed $1,000 to the Alberta Green Party, then moved to Manitoba in October. If that is the case, will we calculate the political contribution as 558 on Form MB428 using the worksheet? Will we calculate the contribution as 550 on the Form AB428 because it was an Alberta political party? Will we report 558 as a contribution on line 40900 of the federal tax return, the regular tax return, or will she not report the political contribution at all? What do you think? So it is a contribution to an Alberta party. Look at the rules. Tell me where you think she can get the credit, or if you think she can't get it, tell me that she can't get it. Okay, I've got about half of you have answered and half of you are still thinking about it. You've got about 30 seconds left. So do think about it. Answering this question will help you not only with the provincial and the federal credits, but it's also going to help you really be organized about how you're thinking about a tax return. Good. Let's see what we came up with. Oh, we got a nice mix of answers here. So some people say she's going to report it as a political contribution on MB 428. Can you report a contribution on a Manitoba Form MB 428 to an Alberta political party? What does the textbook say? No, has to be a Manitoba party. So it cannot be reported there. So A is not the right answer. Can she report it on a Form AB 428? My question to you, is she going to file an AB 428? Remember, the provincial form you file is based on your province of residence. It's the province that goes on the first page of the tax return. So no, she's not filing an AB 428, so she can't put anything on an AB 428, so it's not going to go there. Next question, can it go on the federal line? What can go on the federal political contribution line? Receipts to federal parties. Is this a federal party? No. So it can't go there. What are we left with? Unfortunately, nothing. If she wants to claim it, she's going to have to make another donation to a Manitoba party. But yes, I will say, give your client, thank you, Brittany, give your client credit for being politically active and politically involved. That is a good thing. Congratulations. If she stays in Manitoba and she stays politically involved, she'll get a credit next year. In that circumstance, you won't get it. So when you are putting something on a return and it is a specific line with a specific rule, I want you to go look at the rule and read it very carefully, because it does matter. And again, this is a big credit. They give you a lot of your money back, which means it's also a frequently audited credit. They ask to see it. If you put a political party that is not allowable on your return and they ask to see the receipt, it's a very easy one for them to say no to. So read the rules very, very carefully. And remember that just because you did a thing that somebody else gets a tax credit for doesn't mean you get a tax credit. Lots of people move, lots of people don't get to claim moving expenses. In this case, she contributed to a political party. Lots of people can claim that on their tax return. Because of her circumstances this year, she can't. So just because you paid money out of your pocket doesn't mean it goes on your tax return somewhere. We have to get used to that idea. All right, very good. So that is political contributions. We also have LSVCCs for Manitoba. So if you can remember, just a minute or two ago, I told you the rule federally is it will be a matching one for the Manitoba one because there are no new federal LSVCCs. There is still a matching one. The federal one is limited to 15% of the cost of the shares to a max of $5,000. We don't really have to worry about that because provincially, we're limited to 15% of the cost of the shares to a max of $1,800. So the most you're going to claim in Manitoba will be $1,800. What you get in Manitoba is a receipt called a T2C MAN. Okay, so if you get a slip called a T2C MAN, it will have a line number on it that will tell you the eligible credit, and that will be already a calculation of 15% of the shares to the max. That number you take from the slip, you put it on the Manitoba form, and then you go and you put it on the federal form, and you're going to match it in both places, and then you're done. So the rules themselves are complicated, but we don't have to worry too much about it because you either have the T2C MAN with the number you need on it, or you don't have it. If you don't have it, it doesn't go on the return. If you do have it, take the number, put it on both places. Where does it go? Well, again, I'm going to pull up my non-refundable credits. So I'm going to go to my Manitoba tax form, and you're going to find down at the end, after we've calculated our 10.8% non-refundable credits, this is a special one, it goes after that, you're going to enter your labor-sponsored funds tax credit from slip T2C Manitoba. That goes directly on this line, and it can't be more than $1,800. And then you're going to go into your federal form. I'm going to open up a federal tax return here. I'm going to find the correct page. I'm going to make this bigger so you can read it. You're going to take the net cost of the shares. You'll get that from your T2 MAN, and the allowable credit will match the Manitoba one. That's what you're going to put on line 41400. Okay. I mentioned it briefly. I'm not going to go into more detail because I will tell you in every year that I've done a tax return, I've never had one. They do exist. You might see one. If you see one, you're going to go, huh, LSVCC. There's something about that. I remember that word. You're going to go back to your textbook and you're going to look it up. Okay. So I would put that amount of effort into studying. Remember that it exists. Remember that there are rules. And if it shows up in an assignment on an exam in real life, just go to that section of the textbook and look it up. The nice thing, again, because it's already pulled out on the slip in Manitoba, we don't have to do any calculating. You just have two numbers on the slip. You have the credit you're entitled to, and you have the actual cost of the shares, and that's it. All right, there's a few more things down here we're not going to talk about, but I do want to do personal tax, and I think that's all we're going to have time for today. So we're going to do our review problem next class, I think. All right. So I told you we have fairly high taxes in Manitoba. We tend to end up owing provincial tax. There are a lot of times where we will not owe federal tax because the income is low, but you will owe some provincial tax in Manitoba. That being said, what we do have in Manitoba is a lot of refundable credits. And one of those refundable credits is the personal tax credit. And that's the MB479 for. So the MB479 is all of our refundable Manitoba credits in one place. It's a long document. We're going to learn more about it as we go. Today we're going to start just with the personal tax credit. So personal tax credit, you get a claim for yourself, and then you get an additional claim for your family members. So your partner or your children and your dependents, okay? And again, I haven't taught you about partners and children and dependents and disabled people, so as we get to those, we're going to add to it. But we're going to start with a basic credit of $195. This is one credit per family, so married couple and minor children. The married couple is going to be the people claiming the credit, and you can decide who's going to get it, but you can't split it, one or the other, not both. Okay. Basic credit of $195, and then we're going to reduce it by certain things. And what it is generally reduced by is family income times 1%. So for today, what I need you to know how to do is how to put family income here, which is your net income and your spouse's net income, add it together. We'll talk about the separate rules. We'll talk about the complicated family situations later. So for now, we're going to get family income. You're going to enter your basic credit. As I teach you the other things, you're going to start adding them in. You're going to take your family income times 1%, subtract that from all of your basic credits added together. And if there's anything left over, that is a refund that you will get from the government, and you're going to put that on the return. The rest of this form we'll talk about later, which is the education property tax credit. Most of you will have heard of the rent credit. If we're talking rent credit, that's where it goes. We'll deal with that later. Let's make it easy for today. So I'm going to have you skip the rent credit portion, the education property tax portion, the senior school tax rebate, the school tax credit for homeowners, the rent assist, primary caregiver tax credit we're going to do later. Fertility we'll do later. The last ones in the book are all for businesses, and we're not doing businesses in this course, so we're going to skip those. The last one you need to know, which is new, it came in 2021, is a teaching expense tax credit. It is a refundable credit for eligible school supplies for an eligible teacher to a max of $1,000, and in Manitoba you get 15%. So federally, whatever you got for federally, you're going to get the same thing provincially for the same rules, same requirements, same everything to a maximum of $1,000, but provincially you're going to get 15%. Okay? That's basically all I need you to know. The one difference is you don't have to have been resident in Manitoba when you were working as an educator. So if you were an educator in a different province, and at the end of the year you moved to Manitoba, in that case you can still claim this credit in Manitoba, but you're going to need to go find a more senior associate because you're going to need to do a special form. So if you do have someone who was a teacher in a different province at the beginning of the year and they move here, I want you to know that you can claim the credit, but you're going to need some extra rules to do it, so go get some help for that one. Generally speaking, if you were a teacher in Manitoba and you're still in Manitoba, you're going to get it, and that makes it nice and easy. Okay. And then climate action incentive. If you had questions about climate action incentive, who qualifies, how you calculate it, what you get, all of those things, and I did not cover that last class. There's more information on the Manitoba side of things here, in addition to how it's calculated and how much they get. I only have the numbers for 2021 though, because we don't have the numbers for next year yet. They have not been released. So we just don't know what they're going to be. It will give you the schedule. You already know how to do this. It's going to talk about the supplement. And if you want to know where to find the map and what the municipalities are, it's in your provincial supplement as well. Okay? And then who's not eligible is in here as well. So more detail than you got in the federal book about climate action incentive you're going to find in this book because it's relevant to our province. Okay, and that's it. Everything else in here we're not going to do. So we have 3 minutes left of class. I'm not going to try to do the review problem in 3 minutes. I will do the review problem at the beginning of next class. What I want you to do is make sure you can now get to the end of a tax return. So you know how to calculate taxable total income, net income, taxable income, federal non-refundable credits, find out how much federal tax is owing. You can now calculate provincial tax owing, provincial non-refundable credits, put that on the tax return. Then you're going to calculate your refundable credits federally, your refundable provincial credits. Then you're going to have to put how much money they actually paid in tax. Where do I get that number from? On a T4 slip, box 22 is what you actually paid. So any tax you actually paid on a tax slip will go here on line 147. Okay. I'm going to show you one really quick thing in the textbook that might be confusing. So bear with me because this is relevant to your review problems. And if you missed it, you're going to have a chance to redo it. What we are doing up until now, we have been showing you T4 slips with box 22 filled in. Once we get to chapter 5, the amount in box 22 is going to be different depending on what province you live in. So what we've started to do, and you may have caught this, is you're going to notice our box 22s are all blank. It doesn't mean that they did not have any tax deducted. What it means is, depending on what province you're in, you're going to get a different answer on your return. So for the rest of the course, if you see a T4 slip, I want you to look at the bottom underneath the tax slip, and it's going to give you a whole bunch of possible box 22s. Find the Manitoba one. So if we're looking at review problem 5.1 and 5.2 and all future review problems, your box 22, you're going to look for the Manitoba number, and that's what you're going to enter. Okay? Every T4 slip is going to look like this from this point on, probably. So look for the box 22. If it's blank, it's not really blank. Here it is. Okay? You're going to take that. You're going to put it in the return. You're going to add all your refundable federal credits. You're going to add your refundable provincial credits at the bottom here, add all of that stuff up together. Then you're going to subtract what you should have paid in tax minus what you did pay in tax plus all your refundable credits. If it is that you paid too much, you're going to get a refund. So if it's negative, you're going to get a refund. If it's positive, you owe money and you have to pay it to the government, and you are done. And it's 12 o'clock when I said the word done, so we did it. We have finished Chapter 5, except for the review problems. I'll take them up next class. Also, please do the self-test. So Chapter 5 has a self-test number 2. We will take that up at the beginning of next class as well. Thank you for sticking with me. That was a lot. Okay. If you've missed anything, it will be posted on the recordings, and I will see you all next week. We're going to jump in today. We're going to finish Chapter 5 because we missed a few things, so we're going to do the review problems first, and then we're going to do the self-tests, then we'll take a break, and then we'll do Chapter 6. Just share my screen here. Pull out my windows so that I can see you. We're going to finish the last thing that I did not talk about at the end of Chapter 5, which is direct deposit. So we talked about what happens when you get to the end of the tax return. At the end of the tax return, you're going to get an answer that says either the taxpayer owes money or the taxpayer is going to get money back from the government. So when they get money back from the government, we call that a refund. Generally, it means that they've already paid money to the CRA, and then they're going to be getting some back that they've already paid in. And sometimes that refund is for people who, even if they haven't paid any money, they are getting refundable credits from the government. So those are the two circumstances where we will see a refund. If you get a refund and you have signed up for direct deposit, that money will go directly into the account that you told the CRA to put it in. Can anyone tell me in the chat window what happens if you're not signed up for direct deposit? How do you get refunds from the government if you're not signed up? You get a check in the mail, and it's going to go to the address that was on your tax return. So that's important to explain to clients as well. The address that is on their tax return is where their checks will go. Okay, direct deposit used to be something that we as tax preparers could sign our clients up for. So we used to have a mechanism where when we filed the return, we could also change their direct deposit information. That has not been the case for the last few years. What happened when the CRA started paying COVID benefits is there started being a really big incentive for people to commit fraud by getting people's personal information, getting enough of it so they could file fraudulent tax returns, and then what they would do is they would get they would change direct deposit to an account that the fraudulent person could access, and then they would file applications for COVID benefits for CERB and what then became CRB, collect a whole lot of money, which is now taxable to the taxpayer, except the taxpayer wasn't the one asking for it. Money would go into direct deposit, and then they would leave. So in order to make it harder, and Brittany, there was a process to help people who that had happened to. So the CRA has pretty much a dedicated fraud department just dealing with what happened in 2019 and 2020 tax year for those people. But in order to make it harder to do, they have tightened the ways that people can change their direct deposit info. So now, in order to set up direct deposit, we basically have 4 options. The first is the client can do it through My Account. So we can't do it to represent a client, but if the client is signed up for My Account, they can change their direct deposit by logging into their My Account. And there's a little button on the right side of the screen that says Update My Direct Deposit Info, and they can do it there. They can do it over the phone with the CRA. When you call the CRA to do anything with your account, you have to verify your ID. They have a series of questions that you have to answer. Once they've verified your ID, you can change your direct deposit of the phone. You can change it at your bank, and this is the one we recommend the most often because it's the easiest one to do. You have to get your banking information to change your direct deposit anyway. Might as well go to your bank and say, hi, banking person, please, I want to update my direct deposit info with the CRA, and they have their own forms to do that. And of course, it's secure because at the bank, they will ask to see your ID before they will do that. And then the final one is there is a direct deposit form. It is a paper form that you fill out and you mail. And so if we have a client who, for whatever reason, doesn't want to go to their bank, It doesn't want to call the CRA, they want to do it by mail, we can do that. So we will be showing you how to do that. What happens if you sign up for direct deposit and then you put the wrong information in? So what if you put the wrong account number for direct deposit? One of two things will happen. If the account does not exist, or if it's an old account that was closed, it will bounce and the CRA will notice that it's not a valid account and they will put a pause on your direct deposit. They'll cancel your direct deposit and they will send you a check. So that's the good scenario. However, it is possible that the account could be a real account. It could be somebody else's account. And Brittany, you are correct. If you tell the CRA to put money in that account, that is where the money's going to go. Can you go back to the CRA if they put the money where you told them to and say, oh, I didn't mean it, can you get it back for me? Is that a thing that the CRA will be able to help you with? Unfortunately, no. And we did have this happen. And in this case, it wasn't our fault. The client gave us the wrong direct deposit information. The client was doing returns for themselves, but they had a lot of family members, adult children, things like that, and they gave their own, instead of their own direct deposit information for their refund and their government benefits, they gave us the account for their adult child, who very happily took all the money and spent it. And the only way to get the money back is to sue the person who received the money, unfortunately. Once you tell the CRA to send the money to an account that exists, the CRA is going to do what you told them to. And if that's not what you wanted to do, you cannot blame the CRA for doing what you asked them to. So be very, very careful. If you are doing direct deposit for a client, if you are helping a client with direct deposit, get them to verify before they go that that is definitely the account that they wanted. In this case, we had actually done that. It was just one of those scenarios. Karina, it's the responsibility of the person who gave the direct deposit info. So if they've given you direct deposit info and you did it right, that's their problem. If you weren't being careful, well, that client could be very angry. So in that case, we want to avoid that. I always triple check my direct deposit info when I put it in, and I get the client to verify it one more time before I send it. That being said, we solve this to a great extent because right now we can't really do it, and the mail is very slow, and most people want their direct deposit information updated very quickly so they get their benefits as fast as possible. So going to the bank is a lot easier. And Helene asked, can we help a client set up my account? We don't necessarily help them directly because it takes time to set up a My Account. They apply online. They will then answer some security questions, which we can help them do. We'll tell them what numbers they're going to need from their tax return in order to answer those questions. Then the CRA will mail them a PIN number, and then 10 days after that, they'll get it in their post office, they'll pick it up, and then they can enter that PIN number and they will be set up. So we don't usually help them with the second part, but we do make sure they have the information that they need so that when they set up their My Account, they know which numbers they're looking for. There's a code they'll need on their notice of assessment, and there are line numbers they'll need from that notice of assessment. And those two pieces of information we can help them find. Okay, so direct deposit, all I'm going to say for that is it is good for clients to have direct deposit. It is a really good way to get their money quickly. It is much faster to get their money through direct deposit because if it's going to be sent by check, first of all, the CRA has to process it, then they have to print a check, then they have to mail a check, and then it has to get to your client. So for all of those reasons, the fastest way is to have direct deposit. Just be very careful if you're putting direct deposit information on a form for a client that you're being very careful about it. And generally speaking, the advice I give now is get your client into one of those faster routes so that they can get direct deposit set up quickly. The slowest one is the one that we can do, which is mailing in the direct deposit form. All right, let's jump into our review problems next. So we have two review problems for this chapter, and they are fairly complicated ones. We're getting into full tax returns now. So we're going to jump into Bill Sanderson first. I'm going to go quickly through the opening, but I want you to remember when I do a case, I do the same steps every time. I'm verifying the age, I'm checking marital status, I want to make sure that the address is correct, I'm thinking about the first page of the tax return very carefully before I do anything else. Keep doing that. I may not repeat it as we get into more complicated ones. I need more time to talk about other things. All right, so we have Bill, he's a widower. I have a T4 for him. Remember, the box 22 is now located below the tax slip because we are dealing with different provinces. Anyone taking this course across the country will have the same case, but they're going to have a different box 22 number if they're in a different province. We want to look for the Manitoba ones. Okay. I also know that he worked from home. He worked on his kitchen table. The kitchen is 12% of the square footage of the house. And he also uses it for personal things. Of course he does. It's his kitchen. That's where he eats food. So I'm going to have to prorate it. In this case, if I'm prorating it, how much of the total cost of his home, if I'm doing detailed method, will he be able to claim? So I have 40 hours a week divided by a possible 168 times the 12%. And of course, realistically, it wouldn't actually be 12% unless he has a very small kitchen or a very small apartment and a big table. If he's using his kitchen table for work, it's only going to be the floor space of his table to his chair. But let's go really, really big and say the whole kitchen is used working from home, 12%. 2.9% is what I'm left with. So I'm going to take the 12%, multiply by 40, divide by 168. And that gives me 2.9. I'll round it up to 3. Why not? Let's be generous. So what I can then do is I can take 3% of his total internet utilities. If he had rent, I could include that in there, whatever is going to fit in there. It looks like he doesn't have rent. It will be more than that. I'm going to take 3% of that, and what do I get? So 3,780, 3% of that is going to be roughly, and here I'm not necessarily going to need exact numbers, because I can already tell you we're not going to be using them on the tax return. How much of the utilities can we claim? Let's get a volunteer here, possibly. About $113.40, if I'm being really nice. You can use the 2.9, that's also correct. The point in this case is that we're not doing any of it. We're just using enough calculations to know that it's not going to be his best option. So 2.9 would be correct, 3% if we're going to be extra generous. Plus the $50. So total, if I use the detailed method, the maximum I can give him is going to be about 150, 160 bucks, something in that neighborhood. Yep. Okay. If I do the flat rate method, how much can I give him? Possibly 500. The tricky one in this one, he's in Manitoba. We have a lot of stat holidays. If he's working 5 days a week, we're going to have to ask him, did you take any vacation? Because in real life, it's probably a little less. I'm going to tell you for the purposes of this case, we're going to assume that for whatever reason, he did not take any vacation and it was just that. And yes, Brittany, assume you get the max if the case doesn't tell you otherwise. For the cases, I will say in real life, never assume they get the max because they almost never do. In real life, you have to dig into it. For the cases, we can be a little more careful and assume if I didn't tell you anything, it's probably not relevant. But you can also always ask. Consider me to be your client. If you have a question for Bill, send me an email and say, hi, Bill, I'm preparing your tax return and I have a question for you. And I will answer the question as if I am Bill. I do that for these cases because sometimes they don't make sense and I want you to think of them as real cases. So we're going to say in this case he can claim the max. He worked the entire year and didn't take any vacation, and so we can give him $500. Which is better, a $500 deduction that he needs no paperwork for, or a $160 deduction that he needs paperwork plus his employer has to sign another thing? We all agree 500. So we know he has two options, and we know which one we're going to pick. Excellent. We also know he exercised the stock option. So I'm going to have a box 38 and a box 39. I want you to remember box 38 is already included in box 14. He is being taxed on an additional $2,000 that he did not get in cash. He got a benefit. He got a discount on some shares. So he owns some shares and they were cheap. And all of that works out to a value of $2,000 that he has to pay tax on. What will I do with box 39? Box 38 is already there. I've added it into income through box 14. What will I do with box 39? Good. I will give him a deduction. And the important thing is to know this deduction is coming off after we calculate net income. So we're going to calculate net income first, use that to calculate any benefits that he might have, and then we're going to take it off before we get to taxable income. So this is one of the ones you might have forgotten. All right, and he contributed $300 to the federal NDP party, and he has a receipt. What can I do with that? I have a receipt for a donation to a federal political party. You can give me a line number. And Brittany, be careful when you say deduction. We're talking about numbers that start with 2. This is not a deduction. It is a non-refundable credit. And it's a special non-refundable credit because it's not 15%. We're going to use the federal worksheet to calculate it. Excellent. Good. Is that going to show up on the provincial forms anywhere? We have a political donation. Be careful. This one, you do not match the federal and the provincial. So I'm going to make sure we don't do that. And he does want to sign up for a direct deposit. For whatever reason, he does not want to do it through his bank, and he's not signed up for my account yet. So we're going to do it the hard way. We're going to do the paper form for that, and I'll show you what it looks like. And we have to do provincial forms. And I think that's everything. So we've talked about COVID, working expenses. We've talked about the details. We've talked about which method he's going to use. We've talked about the donation. We're going to calculate the provincial political tax credit. We'll do that on the form together. We'll talk about the non-refundable tax credits he can claim in which lines. And we know for direct deposit, he could sign up through my account if he's on my account. He can call the CRA, he can go to his bank, or we can do the form for him. Good. Let's jump into the forms because I want you to see the provincial ones. This is the first chance you're going to see what they look like. So here we have Bill Sanderson. We have his address. I put him in Winkler. Manitoba R3, R3T. You should put him where he is, where you are, rather. Social insurance number, date of birth. He's widowed in this case, English. Don't forget Manitoba, province of residence, very important. You have something there. No spouse for this year that we need to account for. And we're going to say yes and no. Income, nice and easy. Take the number from box 14, and we're done. So total income, carry it down to the bottom of the page. We have a pension adjustment, which is a reporting number, but very important. You'll know why it's very important when we get to the chapter on RRSPs. We have a registered pension plan. That's a deduction. Give him his deduction. We have union dues from his tax slip. We're going to keep going down until we get to the CPP, and we have to calculate a Schedule 8. You should be very comfortable with Schedule 8s now because you've done a few of them. Don't forget Part 2, Box A. I need to see the number 12. Always think about that box because if you think about that box, it's going to be that little trigger in your head to double check their age because that's the one that we'll forget when we're doing them by hand. So think about the age. It's also a good place to look for a mistake when you're using the computer program. If you get a weird CPP number, you can't figure out why it's weird. Sometimes you type the year of their birth wrong, and that's why it's weird, and it's a really hard problem to catch. You won't notice it on the first page, but you'll notice it in the CPP. So always thinking about that, Part 2, Box A, double check that, make sure it makes sense. All right, 61,600 is the max. We're going to take box 26 and put it there, subtract the base amount. That gives us the maximum pensionable earnings. We're going to look at his actual, which in this case separates out to 2,416.59 and 244.10. We're going to look at his allowable, which is exactly the same. So we know no overpayment, no underpayment. His employer got it exactly right. And then we can take either the actual or the allowable in this case because they're both the same. And those are the numbers we're going to use. We're going to take the required enhanced amount. We're going to put it as a deduction. We're going to take the rest and put it as a credit, and there's no refundable amount. And yes, Brittany, way to go, employer. I will say for this employer, it's easy. He worked for 12 months, and he made enough money. So for them, it's a very easy calculation. Right. Back to here, we now have deduction for CPP. We've hit the other employment expenses. We've thought about doing a working from home. We need a form. What form do we need if we're doing the flat rate? Now we're going to do the flat rate working from home expenses. What is the form? Be careful, Heen. T777 is a different form. It sounds very similar. T777S is the one we're looking for. The problem is there is a slip called a T777, and it is a different slip. If you open that slip, it's going to look very different. So this is the one we want. It is a T777S, and it means we don't need anything else from his employer unless the CRA asks for confirmation that he had to work from home for COVID. In that case, we will get a request for info at some point in the next 3 years, and we'll go back and get it. All right, and we're going to put the max for him, which is $250 for 2021 times 2, $500, and that's it. Take that number, put it back on the tax return. It's going to be one of the easiest forms you fill out. The only easier form, I think, for this year is if you're doing a Schedule 14 for a rural Manitoban. That's just one box, then you put a check mark in it. All right, so we're going to take all of those. If you take RPP, union dues, CPP enhanced portion, and the working from home credit, you should have gotten 1980.10. Gives us a net income before adjustments of $50, $339.90. And security options deductions then going to come off net income. There's the $1,000. Don't forget that $1,000 deduction. Even though it's on a T4 slip, the CRA knows about it. They're not going to voluntarily put it in for you if you don't ask for it. So make sure you ask for it. That gives a taxable income of $49,339.90. Good. Now we get into the bulk of the federal return. He's in the second tax bracket, so we're going to use the second column. We're going to calculate how much of his income is over that threshold times 20.5%, and then we're going to add 15% of all the rest, and that gives us $7,418.58. So his federal tax owing before we use non-refundable credits is $7,418.58. We're going to give him the personal amount. He doesn't have to do anything with that personal amount because he's in the bottom 3 tax brackets. Remember, if he's in the top 2, we have a little extra calculating to do. We're going to give him the CPP employment. You should have done a T2204. If you did a T2204, you're going to see that he got the right amount. But you should do one to double check that. Okay. 826.66 is correct, so he can claim all of it. Canada employment amount, don't forget that. I told you we're going to get into harder things, and you're going to stop putting that one in. Think about that one. We're going to add all of those together, and that gives us total non-refundable credits of $18,308.25. Carry that down, take 15%, and right off the bat, we can reduce another $2,700 roughly off of his federal tax, so that's good. Taking money back from the government and putting it back in his pocket. We're going to do that deduction here, which gives us a basic federal tax of $4,672.34, and then we're going to see if he has any extra non-refundable credits to work with. And of course, we have that political donation. So we're going to do that one next. We need a worksheet. So you should have done a worksheet. It should look like this. This one's easy because I can do the math without using the worksheet. But if you don't send the government the calculations, they will not accept your calculations. So if you're doing a paper return, even though it's obvious what answer he gets and you know what he's entitled to, you still have to do the math for them. So practice preparing your worksheets. Okay, if we were filing this electronically, we would be sending a worksheet, or at least the figures from the worksheet electronically with the rest of the tax return. So worksheet is going to be the first column because it's less than $400. He can get 75% of all of it back, and that is what we're going to end up putting on the return. So we're going to put the $300 number on the reporting line and the $225 number on the credit line. I'm going to jump back to my return now. There's the reporting line. There's the credit line down at the bottom here. We can take another $225 off his federal tax. And that's going to give a net federal tax of $4,447.34, which we're going to put in step 6. So in step 6, we know he needs to pay at least $4,447.34 to the government, and that money will go to the federal government. They get to keep it. Okay. Then we get to the provincial line, and we have to do the provincial forms. So I'm going to jump in there, and I'm going to start with an MB428. And I'm going to take his taxable income from the federal return. And here he is again in the second tax bracket, so we're going to fill that out. That gives us our base Manitoba tax, which is $5,633.23. Pretty high. If we had done this in Alberta, it would be a smaller number. If you're curious about what it looks like in a different province, go ahead and calculate it for a different province. You can find the forms online. You don't have to. All right, now we know what we're starting with. We're going to take our provincial non-refundable credits, and we're going to start with the base amount. The base amount is the same for everyone in Manitoba, so we're going to fill that in 9936 automatically. Then we're going to match the ones we can. So CPP and EI, whatever was on the federal one has to match on the provincial one. You're going to notice that there are other ones that he got that we're not going to give him. So other credits that he got were the Canada employment amount. That you're not going to see here. Okay. That gives us total credits of $13,179.25. $13,179.25 carries down, and he's going to get 10.8%, which is $14,23.36. We can then take those tax credits, and we can subtract it from the provincial, and we're going to leave with $4,209.87. And again, I want you to notice that we're not going to put the political contribution in twice because he didn't also contribute to a provincial party. He only contributed to a federal party. All right, so his Manitoba tax is there. That's going to go back on the tax return. And yes, one in typo ruins the whole form. The one we missed, if you don't think about it, is the family tax benefit. So this one, if I was doing this one, and I knew he had no spouse and no kids and no dependents and his income, I would know that I didn't have to worry about this form. But this is the first time doing it. You should practice these. So Manitoba family tax benefit, he gets the base credit of $2,065. We're going to take 9% of his net income now, not taxable income, net income, $53,390. And we're going to see he's not going to get the family tax benefit. As soon as I start teaching you about dependents, dependent spouses, eligible dependents, minor children, you're going to start to see this form come into play in a really big way. So don't forget it. Start practicing it now when it's easy. As we start to make it harder, you're going to be more comfortable with it. Okay? And then we need to do an MB479, but in this case, the max credit he can get is the base amount of $195. We're going to reduce that by his net income, and I can tell you, again, without even doing it, we're not going to have a refundable provincial credit for him. At this point in the course, we'll talk about it when we talk about rent credits later. Okay? So I've done my provincial forms. I'm going to head back. I'm going to put the provincial number here. Then we're going to find out his total tax owing. So what he should have paid in tax for the year is $8,657.21. I have to look at what he did pay in tax. So that's the number we're going to get from box 22, in this case of his T4. Box 22 of his T4 said $9,621, so he paid more than he needed to. We're going to check if he has any other refundable credits. He doesn't, but he might have. And we're going to get a refund in this case. So because he paid more than he needed, he's going to get the difference back. You're going to see a negative amount here, which is $964.63. and a refund of $964.63. If you did not get the right answer, don't stress about it. This is practice. The more practice you do, the more you're going to get to do the forms. So I know it's really frustrating if you made one typo somewhere, you left one number off, and now you have to calculate the whole thing again. I've been there. I took this course as well. But every time you do that, it gives you another chance to practice going through the forms. So that's not necessarily a bad thing. Okay. If you didn't get the answer here, you've written it down and you're not sure and you can't make it match what I did, send me yours. So email me your completed forms. I will look at them. I will go through them. I will tell you what to fix. And then if you get them done and you want me to check them, I'll check them again. I will check them as many times as you need until you have it right. So think of this as practice. Good. Do you think he's going to get the same refund next year? Did anything unusual happen this year that might not have happened next year? He might not be working from home next year. So the COVID might go away. That's a $500 deduction. That was worth some money to him. What else? What was another thing that was new that probably only happened once that affected his tax return? And I will give you a hint. Federal donation. So maybe he doesn't make another one. Stock options. Remember, he got a $1,000 deduction from stock options. His employer might not do that again next year. So when you have a refund and you tell a client this is your refund, you're not finished. You want to look at next year and say, all right, you got 900 and something back this year. Just so you know, a good chunk of that was from these two things. So if those two things don't happen again, then expect that next year you're not going to be getting a big refund. So he knows that if he wants a refund again next year, he might have to do something else. Maybe he is still working from home due to COVID, but if it turns out he's going back to the office, you need to let him know his tax return is going to look different next year, and then you can have a conversation about other things that he could do. Excellent. Good. Let's go on to the next one. Charitable donations, yep, or RSPs, or just preparing to not have a big refund. Sometimes it's good to not have a big refund. It means you've loaned the government money for a year. Maybe you didn't want to do that. Maybe you wanted to have it to spend all year. But as long as your client knows what they're expecting, they're in a good place. You don't want to have a client come in, give them a really big refund, and then next year they think they're going to get the same thing and they don't. All right, let's switch over now to Timoteo Rostem. He is single and we have an address and he had moving expenses. So we get to practice moving expenses, which is good. All right, I now have him living in Winnipeg for me. You can have him living where you are, that's fine. Okay, he lived at an apartment in Riverbend Road in a place nearby until September 30th, and then he got a new job. New job is the key. We want to see the words new job because we know he is moving for a new employment opportunity. Okay, and it's now in our city, and it's 60 kilometers away from his old house. So now we know we can tick the box that he moved, we can tick the box that he moved for work, and we can tick the box that he moved at least 40 kilometers. I can now comfortably think about doing moving expenses. So I am preparing myself to do moving expenses. All right, we have a list of expenses. We're going to come back and talk about those. I want to look at the rest of his return first. Okay, and then during the first part of the year, we have an employer there. And he wants to answer yes to Elections Canada. He doesn't own foreign property. He's not going to do detailed vehicle because he doesn't have any receipts for that. So we're going to do simplified for him. Which province will we use for his vehicle rate? Manitoba. It's easy because the entire move happened in Manitoba. But the important thing to remember is he started in Manitoba. So for some of you who are, again, maybe living closer to a border, you might have to be a little more careful about that one. I know when I was in Brandon, I definitely did a lot of more people who moved to Brandon from Saskatchewan. And so their move may have started right across the border, even though it was still pretty close. We were using a different mileage rate for them. All right, and we have two T4s. We have fire tires with at the bottom a box 22 and Zeal's wheels at the bottom of box 22. We now have to be extra careful with CPP and EI. We always have to be careful with them, but we have to be extra careful when we have more than one T4 because they won't necessarily adjust for each other. And we're going to have to think about our moving expenses, how much eligible income we have. Okay, eligible income is going to come from the new employer. All right, now we're going to go back and see, we're going to claim moving expenses. What can we claim? So $90 for U-Haul, is that a viable expense? Does that count as a moving expense? He has a receipt. Yes, very good. And what type of expense is it going to be? Is it going to be transportation? Is it going to be travel? Is it going to be temporary lodgings? What are we looking at? Transportation. He is moving stuff. U-Haul helps you move things. Okay. He paid a damage deposit on the new apartment. Can we put that anywhere on the return? No. It is specifically not allowed. If you're not sure, read the first couple pages of the T1M. He did have to cancel his old lease. He had a lease cancellation of $1,200. Can he claim the lease cancellation of $1,200? Yes, he can. There's a line for that, and it is allowed as long as he has documentation that he paid it. Okay? And then after he packed up and left the residence, he ate brunch at a restaurant for $14. That was the only meal he purchased. Can he claim his meal? Yes. Good. He has a receipt, and he ate one, and he moved. How much should he claim? $23. Right? Yeah. Very good. Because it's simplified, we're going to. So if you have the option of claiming $14 or $23, and they're both valid, claim $23. We're going to use simplified. The tricky one is a lot of people will think he's eligible for up to 3 meals a day. Why can he not claim 3 meals? Because he didn't eat 3. So the correct answer is because he didn't eat 3. Even if he drove for, let's say, 12 hours, in which case many people would eat 3 meals while they're doing that. If he only ate 1 meal, he can only claim 1 meal. So the important thing is find out how many meals he actually ate, and that is the max he can claim. Now, if he actually ate 4 meals while he was on the road, we're limited to 3 if we're doing simplified method. Okay, so that's the bit where people get confused. Karina, will the CRA ask for meal receipts? They can. If he doesn't have one, but he can show that he did eat a meal, so maybe he kept a log saying, when I traveled, I stopped in whatever place and bought food. Even if he doesn't have a receipt, they will generally accept that. Okay. But they're going to want something to show that he did actually eat a meal. So that's either a record that he kept, and yes, you can do that after the fact as long as you can reasonably say that you remembered it. So have a travel log. When you left, what did you do? What time did you leave of the day, beginning of the day? You packed up your car, on the road by noon, you drove, stopped for a meal, started unloading everything. That's reasonable. Okay. So we know for this case, we're going to do simplified method for the vehicle and for the meals. He didn't have any hotel receipts, but we do have that lease, and we have the U-Haul. We want to see all of that on the return. Okay, I think I've basically answered all the questions here. Yes, we have to calculate the net eligible income at the new location. We'll do that kind of on the form, but generally speaking, net eligible income, you're going to look at Zeal's. You're going to look at box 14. You're going to take a look at the CPP from that employer, and in this case, because he had 2 employers, the safe way of doing it is saying that the base exemption amount was taken off by the previous employer. So we're going to take the full pensionable earnings, which is the box 26, multiply by 0.05%, and we're going to use that to subtract from box 14. don't think I missed anything, but we'll find out if I did. Let's jump into the case. So I'm going to switch clients here, find Timoteo, and here we go. So make sure the address is the new address, not the old address. You do not want checks and other things going to a place he doesn't live at anymore. Be careful when you have multiple addresses to remember which is the one he wants you to use for the tax return. So I now have him in Winnipeg. I have Manitoba as the province of residence. I'm going to say yes and yes and no because that is what he wanted. I'm going to have on line 10100 all of his T4s added together. Box 14 should have been 37,392. Okay, depending what he's doing, if he's working as a mechanic, you might ask about tips. So always looking at what type of work they're doing, should I ask for anything else? In this case, all of his income was on the slips. So there it is, total income. Deductions, in this case, nothing until we hit moving expenses. As soon as I hit that line, I'm going to stop what I'm doing, and I'm going to fill it a T1M. So here we go. This is what you all wanted to see. T1M, make sure you filled in the tax year. Very important. The tax year has to match the date of the move. So tax year is 2021, date of the move is 2021. He moved on September 30th. He started his job on October 1st. That seems more than reasonable to me. So absolutely, I'm comfortable that I don't need any extra proof to say moving expenses related to the move. All right. Distance between his old home and new home was 60. Distance between new home and new place of work is 5. That's 55 kilometers closer, which is more than 40, so we can finish the return. And I'm going to tick off that it is to work or run a business. It is for a new job. I have put Ibn Morris because that's roughly the distance that we're going. You can pick anything you want that makes sense. So I have him moving from Morris to Winnipeg. I have his old address. I have his new address. And I have his employer who is in Winnipeg with postal codes and all the information that I need. This is the employer that I'm going to be claiming moving expenses against. It's the income connected to that employer. How much? Well, we've got $90 from a U-Haul rental, and you will need a receipt for that. Don't put it on if you don't have a receipt. How many people moved? Just him. He's the only person in his house. He is single. He took his car, so personal vehicle, car, anything like that will work. How far? 56 kilometers. Times the mileage rate should have worked out to 29.12, and then I don't need any receipts. I will keep a record of the date that he moved. So generally, you know, did you do it in one trip? Yeah, great. When? What happened? What was that like? So that if he does have to prove that he moved and the details of his move, he has something that he will remember 6 years from now. How many nights? None, because we're not doing accommodation expenses. He did not have any overnights. How many days? 1 day, so we know we can do a max of 3 meals. We can only claim what he did eat, and what he did eat was 1 meal. And we're going to do the simplified method, so we're going to do $23 for that one. So we can add another $52.12. And the cost of canceling the lease, which is $1,200. And for him, that's it. So 90 plus 52.12 plus 1,200 gives me net moving expenses of $1,342.12. Then I have to find out what he can claim. And if we take his income from the new employer and we subtract the enhanced CPP, you should have gotten 9892.29. Any questions about where that number came from? Okay, his income was more than his expenses, so I can claim all of his expenses this year, and I'm going to carry none of them forward to next year. And his move is done, which is good. I can now give him $1,340.12 as a deduction. All right, and there it is. I did it. Then we're going to do a Schedule 8. Schedule 8 we need to look at carefully because he had 2 employers. Don't forget 12 months. So Part 2, Box A12. Max is 61.6. If I add his two employers together, box 26, I get 37,392. Subtract the base amount. My allowable earnings subject to contribution is 33,892. His actual contributions were 1847.13. If I look at his actual and split it out, I get these two numbers. If I look at what he's allowed based on his pensionable earnings, I get these two numbers. You're going to notice they're not exactly the same. He has 2 cents overpayment. To get the right answer on this return, you should give him a refundable credit of 2 cents. So for CPP, they will refund those 2 cents if you've done it. So go ahead, we're going to calculate to the decimal place. So I'm going to make sure that I'm only claiming what he is allowed to claim, which is the smaller figure 1677.65 base amount, and his enhanced deduction is 16946. Those are the two numbers that you want to see. If you didn't get those numbers, you're going to have to recalculate the entire return for 2 cents, which is annoying. And since I'm thinking about it, let's do the EI now. EI 37,392. The middle section in this case is not really going to apply to him, but you can calculate it. I recommend calculating it for practice. But let's take a look at what he is allowed. And here we have a 1 cent overpayment. Okay, and the tricky one is a 1 cent overpayment they will not give you. But he can still only claim the $590.79 as a non-refundable credit. So you need the $590.79 as a non-refundable credit, and that 1 penny is not going to go anywhere. Okay. So I'm going to go here, and I'm going to put my 2 cent CPP. I'm not going to put my 1 cent EI. For non-refundable credits, I'm going to make sure I've used the correct numbers, the 65 cents for the base and the 79 cents for the EI. I know that's a real headache, but we're doing accurate returns. Be as accurate as you can. And I'm going to put the enhanced portion, 169.46 here. Good. Add those together. I get to reduce. I get deductions of 1511.58. Net income is 35,880.42. He does not have anything else, so that's also his taxable income. That's the lowest tax bracket here, 35,880.42. He gets a personal credit. We've done CPP, we've done EI, we've added the Canada employment amount in. That gives us credits of 17,333.44. 15% of that is 2600.02. You might have been a penny off, depending. Try to get it exact. All right, we're going to reduce his federal tax by that amount, which means his federal tax is 278,204. And that goes on to step 6. Then we do provincial. Provincial, here we go. Take the taxable income. Notice he's in the second tax bracket provincially. He was in the first tax bracket federally. Provincial, he's in the second tax bracket. He gets the personal credit. CPP and EI have to match the federal. Watch those decimal places. It's going to give him total credits of 12,204.44. We're going to get to the family tax benefit. He doesn't have a lot of income, so we're going to be careful and we're going to check it. So family tax benefit, we're going to do a 428A. 428A, 2065, 9% of his income. You can see he's getting closer to where he might have gotten it, but not quite enough yet. But if he had had a spouse or a kid or an eligible dependent, he would have gotten it. Oh no, Brittany, you had a typo in the very first line. Yep. And again, if you get it done and you fix it, email it to me and I'll check it for you. Then it's my headache and not yours. I don't mind. All right, so family tax benefit is 0 in this case, but it was close, so it's good that we checked it. No family tax benefit in this one, 12,204.44 times 10.8%. We can reduce his Manitoba tax by 13,1808, which gives a final Manitoba tax number of 259,907. And if you did an MB 479, you should do an MB 479 for all your clients. You'll notice that base credit is 195, but if we take the percentage of his income, he's not going to get a refundable credit this year. All right, so that's going to go here. We're going to take the federal amount, tax owing, provincial tax owing. Total, he should have paid $538,111. He actually paid $5,756.49, and he's getting 2 cents back from his CPP. So he is getting a refund. It's not a big refund, but he is getting a refund, $375.40. Okay. We have 10 minutes. I think we can do the self-test in 10 minutes, and then we'll take a break. Okay? So give me a moment here while I switch my slides. I'm going to stop sharing my monitor just so I can get this set up. So while I'm doing this, I would like you to go into Inkling and get set up for the self-test. Give me a moment to make my computer cooperate with me. It does not like when I have 2 different PowerPoints, so I have to make it agree to open the second one. Get that working. Bear with me here. Use this time to get your self-test answers ready. We're going to do these with polls, so we're going to do it the way we did the last time. Okay, I think I have it now. So I'm going to share my desktop again. And here we have our self-test number 1. Pull out my polling as well. All right, so we have Carol, who is 17 and single. Carol is with her daughter. Her net income was $5,000. Will Carol be receiving a GST HST credit? All right, and let's see what you think. This is nice because it's yes or no. So give me a yes or give me a no. Okay, I'm waiting for 4 people. Waiting for 3 people. Hit the submit button if you can. Okay, just a few seconds longer. I think that's all we're going to get. So let's see our answers. Almost everybody said yes. If you said yes, you are correct. Why? She's 17. She's too young. What is the thing that gives it to her? She's a parent. So that was what we were testing there. Generally speaking, it is related to age and income, but sometimes it is related to being a parent and having income, having low income. So in this case, because she's a parent, she will receive her own GST credit, and it will be a credit for herself and her daughter. Excellent. Good. Let's try the next one. We have Cynthia. Cynthia's employer transferred her to a different city 400 kilometers away. The employer gave her a fixed moving allowance, but she had moving expenses that exceeded this allowance. Should she be completing Form T1M? So there's a few things to think about in there, but if you have thought about it, let's see what answer you came up with. Okay, so you can give me a yes or a no. These ones are nice because you have time to work on them at home before you come into class, which is why I don't give you too much time to answer them. Okay, if you have an answer, hit the submit button so that it registers. Just waiting for a few more. Okay, and I like this one because I got a little bit more of a mix, I think. Let's see what we come up with. All right, so most people said yes, a few people said no. Let's talk it through. Did she move? Yes, she's in a different city than she was before. So we're going to assume in this case we don't have to worry about multiple dwellings and family and all that stuff. She was in a city, she left that city, now she's in a different city. Is it more than 40 kilometers? Yep. Is it a new job? This is the slightly tricky one. It's the same employer, but it's a different city. So it's going to count as a new job. It is basically a different job. So we can file a T1M. Then we have to talk about, can she claim it given that she had an allowance? If her moving expenses were more than her actual moving costs, can we do a T1M for her? So if she had $2,000 of moving expenses and they reimbursed her for $1,000, can we do a moving expense form for her? Yes. We just have to adjust for the allowance. So we have to say the portion she didn't pay for she can't get, but she can get the difference. So she should complete a T1M as long as she had enough above what she was reimbursed to be worth putting it on. So the answer is yes, she should be completing a T1M. If the allowance had covered everything, then no. So that's the tricky one in this one. If the allowance was more than her actual costs or was equal to her actual costs, we would not be doing it. But in this case, if you want to get money back, there is money available for her to ask for from the government. So we should be doing that for her. Okay. And again, we'll be practical. If in the office she was reimbursed for everything except $50, I'm not going to do that one because I'm going to charge her $80 to do the T1M or whatever the fee is going to be, depending on how complicated it is and what the fee structure is. But basically, if it's beneficial in the end, I will put it on for her. All right, let's do the next one. We have Rebecca. Rebecca has been divorced since 2019. She purchased a condominium in 2021. Before the divorce, she owned a home together with her spouse. Is she eligible to claim the home buyer's amount? If you have been reading ahead or you are new or you are prior, you might be more confused than if you are new to this. But let's see if you guys got the right answer. Okay, so she's been divorced since 2019. She purchased a condo in 2021. Before the divorce, so 2019, 2018, 2017, and so on, she owned a home together with her spouse. Is she a first-time homebuyer? Okay, 30 seconds left. See if you can lock in those answers. 18 seconds left. Hit the submit button because otherwise I won't know what you thought. Excellent. See what we did. We got a pretty good result. It looks like most of you said no. The question is, did she live in a home that she owned in the past 5 years? And the answer is yes. So because she lived in a home she owned in the past 5 years, she is not eligible to claim the home buyer's amount. Okay. Where you might have gotten confused is the home buyer plan. Home buyer plan is not a credit, it is income. And we're going to learn about it later. There's a special rule that says if the reason that you bought a home is because of a divorce, you can access the home buyer plan in order to get money to buy that new home, even though you're not technically a first-time home buyer. There is a special rule. We're going to learn about it later. So some people may have gotten mixed up there. But for the credit that we're talking about, the one that I've taught you about and the one you need to know how to answer, she is not a first-time home buyer. So she cannot claim the first-time homebuyer's amount. Okay. Any questions about that one? We'll talk about the income side of all of this in a later chapter when we make things more complicated. Okay, 2 more and then we will take a break. We have Marcelo. Marcelo has a net income of $170,000. Calculate the basic personal amount he can claim. You should already have done this. So I'm just going to open the poll and let's see what number you got. What will his basic personal amount be? You have to ask yourself which tax bracket he's in. Then you have to ask yourself whether or not you're doing a calculation or you're just putting a single number in. Okay, 30 seconds left. So just a few seconds left, still waiting for a few people. Okay, let's see what we did. Really good overall. I will say most of you identified that he is in the 4th tax bracket, and now we need to do a calculation. So it's not going to be the max, and it's not going to be the min. It's going to be somewhere in between. If you're good at multiple choice, you don't have to calculate it. You know that that's the only possible option. But how would we calculate it? Well, we're going to put it into the worksheet. So we're going to take the base amount, which is there. The supplement amount is here. We're going to put his $170,000 in income in. Then we're going to subtract it from the threshold. We're going to divide it by what it says to divide it by. We're going to multiply by what it says to multiply by. We're going to take the supplement, subtract 387.34, gives us 999.66, which when we add it to the base amount is 13,420.66. So that's how you do the math, and that way you get to practice doing it. Okay, if you didn't get that one right, go back to your federal worksheet and give it another try. All right, and we have one more before our break, and that is Nadim. So Nadim has a net income of $100,000. We've told you Nadim's personal credits. So we've given you the basic personal amount, CPP contributions, the base amount, which is nice. We didn't make you calculate it. We gave you the employment insurance premiums and the Canada employment amount, and you are going to calculate the federal tax that Nadine will enter. So we've told you his taxable income. Well, net income and taxable income are the same in this case. Okay? And we've told you his non-refundable credits. You're going to take those two numbers and put them together. So let's see what you all got. Okay, last one. Pick A, B, C, or D. This one's going to be hard to do the math in a minute, but you're welcome to try if you have not prepared it in advance. Give it a shot. And these are some of the types of questions you can expect to see by the time we get to the theory exam. So you'll get a sense for what those questions might look like as well. So some questions, the assignments will be case-based, and theory exam will be this type of multiple choice question where some of it will just be, do they get a credit, do they not get a credit? Some of it will be calculations. Okay, fewer of you did that one, which tells me how many of you actually prepared that one. So maybe try your self-test again. If you didn't do it, practice helps. The correct answer is 15,087.13. Where did we get it from? Well, we can calculate his federal tax. We can calculate his credits. We take the federal tax he should have paid minus his credits, and that gives us the answer. All right, it is 10:03. We're going to take a short break there. It's not going to be a very long break. Yes, Brittany. So the typos is always the problem when you're doing it by math. I will tell you, I'm very not good at being careful with decimal places and numbers. So when I'm doing paper returns, I basically do all my math 3 times. I just triple check every number so that I don't have to do the whole thing again, because it is tiring to do the entire thing from the start to the end. So every number I put on the return, I go back and I go, was that really what I meant? Am I really sure that's what I meant? I do it a couple of times. It just saves me the headaches. Okay. But we do a lot of calculating by hand. So as much as it's nice to rely on computers, the reality is we really do have a lot of math that we have to do, generally speaking, anyway. And we do a lot of estimating where we want to get a sense for what numbers make sense, so that when we look at what the computer did, we can find our computer typos, because we make computer typos when we do data entry as well. So it's good practice. You'll find a system that works for you. All right, I'm going to say it's 10:05 now. We're going to come back at 10:10, and we're going to jump into Chapter 6 from there.